Jared Blickery and Rick Newman have more.
That's right. Those second quarter earnings officially starting off here with those big banks. You got JPMorgan, Citi, and Wells Fargo all reporting. Now, the key data to watch with each of those big banks, net interest income. JPMorgan's profits did surge by 25% from a year ago, but NII, net interest income, fell for the second consecutive quarter by 1%. You can see that putting some pressure on JPM stock. Meantime, Wells Fargo also reporting those shares down over 5.5%. Net interest income for them falling 9%. That is the lowest level for Wells Fargo in 2 years. The company also reporting a decline in revenue from the prior year. Now, Citi initially emerging as the winner this morning thanks to its wealth management business. The stock up over 2% here. Wealth revenue rising 2%, beating expectations. Net interest income at Citi was down 1% year over year, but still above Wall Street estimates for the quarter.
And the June Producer Price Index out this morning shows the fight against inflation may prove trickier than investors would hope. Wholesale prices on a headline basis, they rose 0.2%, slightly hotter than the 0.1% expected by Wall Street. Producer prices excluding food and energy, those rose both on a monthly basis and also on an annual basis. The latest inflation data comes after June's CPI report yesterday showed inflation moderating and even falling on a monthly basis.
And a defiant President Biden pushing back against calls to exit the 2024 presidential race. Biden wrapped up a 3-day NATO summit in Washington, D.C. Thursday evening with a rare solo news conference where he defended his candidacy.
I think I'm the most qualified person to run for president. I beat him once, and I will beat him again.
Americans were hanging on his every word after his poor performance in the first debate prompted doubts over his ability to serve as president for another 4 years. Overall, Biden gave a strong performance on foreign policy, but he did fumble in a couple key moments, mistakenly introducing Ukrainian President Zelensky as President Putin while talking to reporters, and then during the news conference referring to Vice President Trump when he meant to say Vice President Harris.
Let's kick it off with our top story today, and that's big bank earnings. JPMorgan, Citi, and Wells Fargo all starting off the second quarter earnings season. Yahoo Finance's Madison Mills is here with us to help break it all down. All right, guys, we got 3 reports to go through here this morning. You can see them up there on your screen, the banks that did report this morning. Let's start with JPMorgan, because I think initially when we saw these numbers, it looked like it was a very strong quarter here for the bank, but we're seeing the stock really fluctuate in early market action. You can see the revenue numbers there coming in at $50.99 billion. That was a beat there. Adjusted EPS coming in $4.40. So yes, there was a lot of reasons to be optimistic about this report. There are, though, some signs underneath the surface that really point to the fact that JPMorgan is struggling, maybe just a bit, and maybe that's why we're seeing more of a muted reaction. Maybe struggling might be a little bit of a stretch, but the reason for the street maybe not be too excited about this report. Net interest income falling for the second quarter in a row. We know that expenses were up more than expected. They also had the highest provision of loan losses here since the early pandemic days. So all in all, we're seeing more of a muted reaction to this quarter here. And as a result, we're seeing these shares up just around 0.3%.
Yeah, as we're keeping close tabs on JPMorgan shares this morning, one of the huge things that really jumps out to me is what CEO Jamie Dimon had to say, not just about this quarter, but also the environment more broadly, and typically gives us a little bit of kind of that meteorologist weather forecast for the economy. Well, in this one, you got while market valuations and credit spreads seem to reflect a rather benign economic outlook, we continue to be vigilant about potential tail risks. Those tail risks, the same ones they've mentioned before, they also continue to monitor a geopolitical situation. He said it remains complex and potentially the most dangerous since World War II. Interesting to hear, though its outcome and effect in the global economy remains unknown at this juncture. So that in what's really kind of at the top of the mind for the head of JPMorgan as of right now, too.
And he's always saying inflation is sticky. I never get good inflation news out of Jamie Dimon these days. And I guess that did kind of foreshadow a little bit of what we got out of the PPI data this morning. But it's interesting to see, particularly the net interest income data point, I think, across the board for these banks, having some pressure on that data point, even though there was some good news to be had.
Yeah, and also just real quick here, he did also point out that inflation and rates, drawing from what both of you guys were just saying, that actually might stay higher for longer. So exactly, that's a big warning sign here for the markets, just in terms of what has seemed to be priced in, a lot of that optimism surrounding rate cuts before the end of the year.
Absolutely. I'm also keeping tabs on shares of Wells Fargo here this morning. Ticker symbol WFC here, as earnings also surpassed Wall Street estimates, but the stock sliding right now, falling by about 5% here after missing net interest income estimates, hitting a 9% decline versus last year. The company also warning on its lackluster progress for cost cutting here. And so a few of the figures there, the actuals versus the estimates up on your screen. So top and bottom line beat, but ultimately three of the things, two of them I already called out. The expected decline in net interest income, it was in decline as expected here. So that came in essentially with what was already anticipated by the bank, and they acknowledged that. It was down by about 2% sequentially quarter over quarter, but also the expenses here, and it's really signaling a cost-cutting delay. This is a company that's looked across headcount, looked across investments, tried to fine-tune, and they're still going to be making some investments, interestingly enough, into some of their bank branches. And so I don't know when the last time either of you stepped foot in a bank branch was, but as more of that's becoming more digital, more of their customers might be asking themselves, okay, or investors at least might be asking, why spend so much into that experience when you're also trying to make sure that you're tapping into a more mobile client base, especially with more millennials and Gen Z who are going to be getting into more of their wealth management, especially for millennials, getting into some of those peak earnings years, but also for the Gen Yers and all of the baby boomers that are looking towards retirement. A lot of those solutions perhaps needing a human touch, and that's perhaps where they're leaning into revamping that experience. And then just lastly, the narrowing provision for credit losses year over year here. I actually looked at that as a semi-good thing here. At least it's kind of pulling back from some of the high markers that we had seen.
I think it's interesting with Wells Fargo to take a look at the lending numbers, as you mentioned, Brad, because we know from Wall Street Journal reporting that they're losing as much as $10 million a month to one specific program, and that is the Built credit card. The fundamentals of that business don't really make any sense. Wells Fargo still getting into it in an effort to snatch up some more customers, and it's costing them quite a lot of money, and that is just one example of a move that is not going to be protective of a bank balance sheet when you're already having struggles with something like net interest income and the broader sort of struggles that this company is facing in particular. I think looking at that strategy when it comes to lending is interesting, and it is something that all of the banks are experiencing pressure on, but that particular move from Wells Fargo stands out to me. Mm-hmm. Well, I'm also going to take a look at Citi, the supposed winner, I guess I could say, a little editorializing there for the day, but it is appearing as the only one to have a major move to the upside after their earnings came out this morning. They're up nearly 2.5% here. I want to run through just a couple of the numbers. The big thing to watch here was their wealth management business coming in above expectations. You can take a look here that revenue came in just above expectations as well, and so did adjusted EPS. So taking a look at under the hood for Citi here, they're leaning on some of these wealthier customers, right? That's driving their lending, it's driving their net interest income. There are questions about credit quality when it comes to Citi here, but it looks like, for example, the CEO talking about their ability to maintain cost-cutting measures, and they were able to bring down their spending by over 1% here. Still, Citigroup saying that they are going to potentially have struggles keeping costs down. It's going to likely be at the higher end of their forecast moving forward. My main takeaway here, though, is that their wealth management business is what saved them this earnings cycle. To what extent is that a story that we're going to hear about throughout this earnings season? That the wealthier customers, the wealthier businesses are going to be the ones to survive, whereas the ones that are catering to a broader, potentially lower income base are not going to be doing as well. You can see that across the board in some of the bank earnings, but I think more likely we're going to see that in some of the consumer-facing companies.
Yeah, I think that's exactly right. When it comes to Citi and exactly the reaction that we're seeing, I mean, this is a stock that has outperformed since the start of the year when it comes to those gains of just around 26%. I think going into this report, and really the question that analysts and investors are asking themselves right now is where exactly Citi is in this turnaround, whether or not Fraser is going to be able to pull off the turnaround that she has laid out now for several quarters. And you can see by the performance in the stock, the outperformance in the stock since the start of the year, there are a number of believers out there. But I would also cushion that with the fact that they're couched out a little bit, with the fact that there are many skeptics still, just in terms of what exactly that timeline looks like, the ability to do this, cost-cutting efforts that are underway. And of course, when you also bring up the regulatory side of things too, you some questions there about exactly what that looks like ahead for Citi. Those are some of the top concerns, I think, for investors at this point.
I mean, I really look at this equity markets division for them and what they had really touted within this most recent report, where ultimately that division as a part of, or that segment as a part of the markets division, that moved higher year over year by about 37%. Now, of course, there's a lot to look at in this year versus last year. Of course, this year we're looking at some of the strength in the investment decision making, and that's something that the CEO, Jane Fraser, had pointed out as well here. But specifically within equities, equity markets revenue, $1.5 billion, increased 37%, primarily driven by equity derivatives. So you look across the equity markets, they also benefited from growth in prime balances. That was up as well by about 18%. So people looking to get a little bit more of their foot in the door on their equities positions as of right now, and that helping out Citi too.
Yeah. All right, Maddie, thanks so much for helping us break this down. Guys, let's kick it off, or let's keep the conversation going, because we got big banks really driving the market action here this morning. But we also got another piece of econ data out that is really the focus here for the markets, it seems, with just about 20 minutes to go until the opening bell. And that is the producer price index, coming in slightly hotter than expected in the month of June, rising about 0.2% on a month-over-month basis. That was more than what the street had been expecting in terms of that 0.1% growth forecast. Here to discuss, we want to bring in Steve Sosnick. He's Interactive Brokers Chief Strategist. Steve, it's great to have you. So I think my question to you is, when you take a look at the reaction, especially what we're seeing in yields here ahead of the open, it looks like it's pouring some cold water on some of the enthusiasm we have for that CPI print this week.
Yeah, we got excited yesterday. I guess there's an old saying, buy CPI, sell PPI. I don't know that it always holds, but in this case it did, at least from the bond trader's point of view. This is what we're going to see. Is it's not necessarily a linear path. Disinflation is not necessarily a linear path. None of this is a linear path. You have your ups and downs. I think what was interesting was, even despite some easing energy prices that have probably since started to reverse since the last reading, but that the headline number was up even as the core was up. So that's telling us that inflation is still coursing through the system in certain places. And the Fed is going to have a challenging job at their meeting at the end of this month, because it's clear that the labor market is experiencing its own version of disinflation. I don't know what that is if you're growing more slowly in terms of employment, but at what point do they have to start shifting their focus? Powell alluded to the idea of, we have a second part of the dual mandate. It's not just inflation, but how are they going to wrestle with this, and how responsive will they be? And will they be as responsive, I think, as the market hopes, because we're now pricing in pretty much a full shot at a September rate cut. When we think about where consumers and where producers ultimately are having to spend more in the goods versus services kind of calibration, if you will, and thinking about how much more people are spending on services, or producers are spending on services as well here. What does that kind of net out to you? What should we take away from that, knowing that a lot of those services are things like shelter or even energy in some cases? Well, one of the things that struck me is we always get excited because earnings season starts with the banks. And I really kind of wish we didn't, because the banks, we're talking about net interest margin and trading results and prime brokerage. I wish it didn't either, honestly. And it doesn't, because it doesn't really tell us what's going to happen for the rest of earnings season. Yes, you could read through Jamie Dimon and Jane Fraser and the like and their comments. Jamie Dimon, has been sort of like the human glass of cold water, essentially every time he speaks. But that's the only thing you really learn, because no one else is really embedded in broad industry that way. The same, they're embedded everywhere, but their results don't necessarily show it. I thought Delta was more telling yesterday, and I think that was, to me, the kickoff of earnings season, and not in a very good way, because what the story they told was really not a pretty one. What did you extrapolate about what they're saying about the consumer right now, and how that could also be a thread for the rest of the earnings season? My concern is that the consumer is getting the consumer, the U.S. consumer is getting a bit more bifurcated, and I don't know where that bifurcation is. I don't know if it's the median income. I don't know if it's above the median, below the median. I'll leave that for some of the economists to really determine. But my concern is that we're starting to see the consumers, at least at the lower end of the income spectrum, get really stretched and get pressured. And that's not good for the economy. And that's why I want to hear from places like McDonald's and Pepsi and Coke, because they were crowing a few quarters ago about how they could pass on price increases to willing consumers. Now we're talking about $5 value meals and stuff. And so It doesn't necessarily affect the investment world quite so much, because quite frankly, the people who are investing are the people with the higher incomes. That's just, it's just the way it is. But what it means is ultimately the economy does have to really respect what's going on with everybody, because the consumer is 2/3 of the economy, and everybody needs to buy staples.
So, Steve, I'm curious just to get your thoughts on some of the movement that we've seen in the market this week, outside of some of the econ data prints that we've gotten, and even outside of earnings season. We did see a bit of a rotation, at least yesterday, in terms of the underperformance of a handful of those Mag 7 names. We started to see small caps outperform. Do you think there's anything to that, just in terms of a shift in momentum, or is that more of a one-off type of trade, do you think?
I think both. I think yesterday's reaction was a bit extreme, but what it tells me is I've been one of the people who've been advocating for rotation and getting concerned that we've been on an ever narrowing, I've called it stock market Jenga. We just keep building it higher and taking little pieces out of the foundation as we go up. But the problem is, I wonder if we've gotten a little unsustainable on that one, because yesterday, if you looked at advanced declines on NASDAQ and NYSE, they were sharply to the advancers, but the wrong stocks went down. And the problem is, if that persists, if it's a one-off, it just happens. If it persists, when people are putting their money into an S&P 500 fund, whether it's SPDRs or an index fund or whatever, they're expecting diversification, but really more than, about 35% of it is basically in the Mag 7 plus Broadcom. And that's not a lot of diversification. And so if those stocks fail and there's no one to buy that dip, people then will freak out, because they'll see the S&P 500 going down, they'll see the NASDAQ 100 getting thrashed. They have spies and cues. They don't necessarily respond to the idea that, oh wait, there were 3,000 advancers to 1,000 decliners. It's less relevant to them.
Who knew that when we were talking about the broadening, it would really just be Broadcom that we would add on to Mag 7 here. Steve Sosnick, thanks so much for taking the time here this morning.
Thank you, Brad. Thank you, Shauna.
Interactive Brokers chief strategist joining us here in studio. Well, let's switch gears here. The 2024 election, a new poll reveals 56% of Democrats and 2 in 3 adults say President Biden should end his bid for a second term. Most Democrats in Congress still support the president, but calls for him to step aside are growing. President Biden is campaigning in Michigan today after wrapping up a 3-day NATO summit in Washington, D.C. In a rare solo press conference, Biden fumbled another name while defending his candidacy. Let's listen.
Look, I wouldn't have picked Vice President Trump to be vice president, that I think she was not qualified to be president. So let's start there. Number one, the fact is that the consideration is that I think I'm the most qualified person to run for president. I beat him once, and I will beat him again.
Here with more is Yahoo Finance's Rick Newman. Rick, you've been tracking all of what is coming out of President Biden's mouth, what's coming out of former President Trump's mouth. What are the two saying right now? What's Biden's chance, especially with the shifts in the Democratic Party this week?
Well, Trump hasn't been saying much, surprisingly. I mean, this might be the quietest he's been in the last 10 years because he realizes Biden has had a problem with his terrible debate performance and now trying to prove that he's fit for another 4 years in the office. Just to go back to that clip, I mean, Biden was trying to praise Vice President Kamala Harris, and he stepped over himself by using the wrong name. Otherwise, in that press conference, I mean, he was generally coherent, and he actually gave something of a tour de force on foreign policy. I was impressed listening to him describe the nexus between China and Russia. He actually kind of made some news that I think was completely overlooked, which was that there might be some moves out of Europe in coming days to try to further isolate China, as China is trying to push all these exports onto other markets. He sort of said, I don't want to get ahead of myself on this, but I think you're going to be something coming out of Europe. I mean, he had a very sophisticated understanding, and he really did sound like the old school guy who used to chair the Senate Foreign Relations Committee and knows all these leaders. But that's not what everybody's talking about this morning. Everybody's talking about he called President Zelensky of Ukraine before the press conference. He referred to him as Putin rather than Zelensky. He did correct himself right away. He recognized that mistake, but then he described Kamala Harris as Trump, and he did not correct himself on that. And that's what everybody's talking about. As I try to decode, what is the state of Joe Biden's mind, he sucks at names. He's always messing up names. His thinking is coherent. I mean, he sometimes he cannot muster the words, and finally they come out, or they come out a little bit jumbled, and you can figure out. But there's something, he gets stuck on names. So he has Trump at the top of his head, and so instead of saying Kamala Harris, he says Trump, because Trump is sitting right there, and then he doesn't realize that he said it. So I don't think this changes anything. This press conference, one way or the other, about he's more likely, he's less likely to drop out. I think the drama continues.
So, Rick, I guess my question to you is there anything, and Biden kind of talked about this a little bit last night, touching on it very briefly, but are there just some voters that he's not going to be able to convince to change their minds at this point, just in terms of anything he does to try to reassure the fact that, yes, he is fit for a second presidency, just because of the gaffes that we have seen over the last couple of weeks, he's not going to be able to change their minds at this point? And I guess what does that then do in terms of the shaping of the Democrats?
You have to think about different buckets of voters. Yeah. So there certainly are some voters who would vote for Biden over Trump if Biden were a corpse. They would take that over Trump. So that's one bucket. Then there are the hardcore Trumpers. They're going to go for Trump no matter what. Then what we're really talking about is the swing voters in 6 or 7 states. And Shauna, I think there are a lot of undecided voters, believe it or not. There are some polls that show that something like 20% of voters haven't made up their mind. And it's not because they don't know one or the other candidate. These are the double haters. They hate both candidates. They hate the choices that they have in this election. And both candidates, Donald Trump and Joe Biden, are going for those people. And those are the people who are going to determine who the next president is. So yes, there are persuadable people out there. And we've seen presidential candidates before that people don't really love. We have not really confronted the age issue before the way we're doing it this year. So I'm not sure there's a template for how voters are going to break at the last minute if age is their biggest concern about Joe Biden.
That's a great point. All right, Rick, always great to talk to you. Thanks so much for joining us here on Set today. Well, at least 3 more House Democrats calling on President Biden to end his re-election campaign following Thursday night's post-NATO press conference, bringing the total number now to just around 17. Our next guest penned an op-ed in the Washington Post this week titled "The Words About Joe Biden I Never Wanted to Write." Here to discuss, I want to bring in E.J. Dionne Jr. He's Brookings Institution Senior Fellow in Governance Studies. It's great to talk to you. So let's start with your op-ed, because I think it goes directly into the conversation that we were just having with our very own Rick Newman. You're saying it's hard to acknowledge that those who worried about President Biden's age may have been right all along. So here we are Friday morning, post-NATO conference. I guess, has your thought at all changed after we heard what President Biden had to say last night, or is it still the same line of thinking?
No, I'm still on the same line of thinking. I think Rick was very right about many things, but a couple in particular. One is it really was a tour de force on foreign policy. And it was the reason why many of us, I'm somebody who admires President Biden, think he has been a very good president. And I believe that after not only that debate performance, but the fact that they let this go and did very little except a couple of rallies until the Stephanopoulos interview, which I thought was a mistake, that he cannot run a campaign in which Donald Trump, and not he, is absolutely at the center, because all of these questions about him are at the fore. I think about a couple of hypotheticals. One is, what if his folks had decided to do a news conference like this 2, 3, 4 days after that debate? Had they been willing to move quickly and say, we've got a big problem here, and identified it, perhaps we'd be thinking differently. But secondly, what are we talking about here? Unfortunately, from my point of view, unfortunately, we're talking about how did Biden do? Did he flub name a couple of names? We're judging him by that. If you hadn't had that debate, you hadn't had that performance, you hadn't had the questions about him, we'd be talking about how deep his understanding is of foreign policy. And by the way, we'd also be talking about the fact that we seem to have hit almost the Goldilocks point on this economy. The economic news this week is really good. And some of that is Joe Biden, and some of that is Biden's support for Chairman Powell's policies. But we've come out of what could have been a horrible period into a good economy. But we're not talking about that. We're talking about the age issue. We're talking about those mistakes Biden made. And so I think what happened yesterday is that the Democrats were left. Somebody said this to Politico, a Democratic consultant. Democrats are kind of in purgatory right now because a whole lot of them still admire President Biden, appreciate what he did, but they have come to the conclusion that there is no way that the age issue can simply disappear and they can wage the campaign they think they need to run, which is about the dangers that President Trump poses, President Trump would pose to the country. And so I think this may slow down the process, which itself is a problem for the Democrats, because they don't have a lot of time to get this settled. Every day we're talking about this, we're not talking about either the successes of the Biden years or the dangers that Trump poses.
EJ, with regard to that, you have CEOs commenting in their earnings this morning, talking about the geopolitical situation. Jamie Dimon saying it remains complex, potentially the most dangerous since World War II. Coming off of a NATO summit like this, does Biden's performance assuage any of the concerns from some of those top donors that have stepped away or at least paused some of their contributions?
Well, I think today, actually, between now and the end of the day, is going to be telling, because first you're going to see how many more members of Congress come out and say, we love Joe Biden, but we think he should drop out. For the donors, it's hard to say. I think the donors who have made their decision are not going to change on the basis of one news conference, because they're going to say, will every Biden event going forward be another test where we're sitting on the edges of our chairs to try to see what Biden is going to do? But did he do very well, especially when he was talking about foreign policy? Yeah, he did. It's something Biden can take pride in. I think there are a couple of little changes that may have happened. First, Biden was just ever so slightly more open to at least the remote possibility that he might step aside. He said very strong, good things about Kamala Harris, even if he got her name wrong initially. And he said, he didn't just say, there's no way I'm out. He said, well, if I weren't the strongest candidate, maybe this could be justified. He opened the door at least a crack. I think that's tactically smart on his part, because I think the hard push everybody aside approach clearly wasn't working as all those members of Congress came out. And I think the other thing is, one of the fears that if you are supportive of Biden, including if he needs to get out of the race, is, well, if he leaves the race, will people try to force him out of the presidency? I think he made an excellent case yesterday for why it makes perfect sense for Biden to say, I'm not running, but to stay in the White House until January 20th, 2025. And so for the people on the side who sadly think that Biden has to get out, I think that is one advantage of what happened yesterday.
So, EJ, two quick questions here. One, given your extensive knowledge and the history and everything that you have seen in the past, how do you see this playing out? Or what is your best guess just in terms of the conversations that you're having right now in D.C.? And then two, how hard would it be for the Democrats to start from scratch at this point, this late in the election cycle?
Well, it's unprecedented. And I've heard from a lot of people and have heard about a lot of other people who think that it's not sustainable for Biden anymore after that debate. And I do think, there were reports that dozens of Democrats were expected to come out today and say he's got to go. I think Nancy Pelosi has clearly signaled her doubts. I think you're hearing a slightly different tone from Hakeem Jeffries, the leader of the Democrats in the House, who's a very carefully cautious person. And so I think it's very hard. I mean, I do not pretend to know how this will turn out, because this is, as you suggest, unprecedented. And I think the other thing is, the problem Biden has, I think, is if he makes any other serious mistakes, maybe flubbing a couple of names is not enough, and people do that. I've done that. But I think that I think any other major mistake he makes is a real problem. How hard is it to do? It's not easy, but I think the question is a switch more dangerous, or could it energize the campaign?
Right.
Someone wrote recently about New Zealand, where the person who became Prime Minister, Ardern, jumped in a race for the Labor Party down there 2 months before the election because the party looked like it was going to lose. And she won that election and became a very successful prime minister. I think that a switch is risky, but it has some high potential for generating new energy.
EJ, thanks so much for taking the time here. We got to wrap things as we're seeing the opening bell happen right now. EJ Dion Jr., who is the Brookings Institute Senior Fellow in Governance Studies. Thanks so much. You're taking a look at the opening bell at the NYSE and at the NASDAQ, where you've got the 99ers ringing the opening bell at the New York Stock Exchange. And then at the NASDAQ, you've got Above Food ringing the opening bell. We saw some funfetti on this here Friday. All right, let's take a check of the major averages here in the U.S. as you're taking a look at the Dow, the S&P 500, and the NASDAQ on your screen. Let's just run through them. We're higher across the board. There you go. It's done. No, just kidding. Dow's up by about 0.2%, 0.1% in gains for the S&P 500 and the NASDAQ here.
Yeah, we're also taking a look, if we can flip over real quick to the bond market maybe. We're also seeing some reaction play out still with the climb in yields, a bit of a reversal from what we saw earlier this week. This on the back of that PPI data coming in slightly hotter than expected. Not a huge move to the upside. You've got the 10-year yield now right around just above that 4.2 level. All right, let's kick it over to Jared Blickery. Give us a closer look at some of this movement that we're seeing as we wrap up the trading week. Jared.
Yes, I have been watching the energy market. That is the second best performing sector of the day. XLE up about 0.6% there. But I want to check in on crude oil first. CL equals F. That's up 1.17% today. And let me just show you what's been happening this year. And you can see we have come off these June lows here into potential resistance. And the news of the day, we did have a bigger drop in inventories than we were expecting yesterday. That was reported by the Department of Energy, the EIA. But nevertheless, we're seeing prices a little bit higher this morning. In fact, crude has been on a 3-day run. And if you think about some of the factors that have been influencing it, you got to take a look at OPEC Plus. We're not expecting any news from them for a couple of weeks. We usually get that around their meeting around the change, the very beginning of each month. And then just thinking about earnings, it is earnings season now. Let's take a brief look at the energy sector, our energy heat map. And I'm going to put year-to-date prices. You can see a lot of green today, but here we go. Exxon is up 14%, Chevron up 4.5%. Kind of in line with the overall market. We have energy up about 7-8% on the year. Next week, we do get earnings from Schlumberger on Friday, as well as Halliburton. That's going to kick off earnings for the oil patch. And then a week later, we're going to get Exxon and some of the other majors. One thing that does stand out, the U.S. oil majors are different from their international counterparts. U.S. investors expect them to return more cash flow. You'll notice in the upper right there that ConocoPhillips, BP, Schlumberger, those are down. And all I can say is sometimes the oil services, they act counter to what we're seeing in some of the majors. Guys.
All right, Jared, thanks so much. Teeing up the rest of today's trading activity and the final trading session of the week. Hey, coming up, we'll finally get to the B block of the show. Tesla shares falling on a downgrade, and we've got the top trending tickers next. We're watching shares of Tesla this morning. The stock falling after analysts at UBS downgraded the EV manufacturer. The firm believes that Tesla shares have risen, quote, too much, too soon over its AI plans here. Shares are down right now as we begin the trading session by about 2.5%. Over the past 5 days, you've seen slippage of a little more than 6.5%. And additionally here have reports about the robo-taxi day being potentially pushed back as well here.
Yeah, this is a valuation call here from Joseph Spack, the analyst over at UBS. And he's talking about the fact that if market enthusiasm for AI does diminish, that this may impact Tesla's multiple here going forward. And he's making the case that this downgrade is warranted, quote, given the lack of visibility and the risk that growth opportunities materialize on a longer term horizon. And then he put in parentheses, or not at all. And I think that's a big question that so many investors, so many analysts are asking themselves this morning. There was lots of excitement surrounding the robo-taxi and exactly what that was going to entail, what that would look like, how big of a driver, a catalyst was that going to be for the stock when we were initially expecting that to happen just next month. And now reports that it has been delayed. Of course, this calls into question exactly a lot of that excitement that we've seen in the stock over the last 5 to 6 weeks, whether or not it has certainly got a little bit ahead of itself. And it's also important to point out that Joseph Spack isn't alone in terms of this call. A number of analysts here had a bit more of a bearish tune maybe over the last 24 hours when this has been called into question, just exactly maybe what that near term could look like here for Tesla. And we could potentially see a bit more volatility on the back of the massive rise that we've seen since the start of June.
Elon wants to be thought of as an AI company. He was very clear about that on the most recent earnings call, saying, and giving credit to Cathie Wood, saying that she said it best, like really, we should be thought of as an AI or robotics company. If you value Tesla as just an auto company, you have to fundamentally just understand and ask the wrong question. The right answer is impossible. He kind of rambles on, but he eventually got to the point where saying Tesla is going to solve autonomy, and AI is a huge part of that, as well as robotics.
All right, coming up, keep it right here on Yahoo Finance. AT&T customers are getting hacked. The stock dropping as a result. Now, this is in addition to that hack that was announced earlier this year. We're looking at shares off just about 1%. Snowflake also falling in tandem with AT&T. We'll tell you why next. Time for some trending tickers. Another bank that we're watching this morning is Bank of New York Mellon. You're looking at shares of just around 3.6% after the company posted Better than expected results. BNY reported a 10% increase for its second quarter net profit. That was thanks to higher investment services fees. And when you take a look at the stock reaction here this morning, we're looking at the biggest intraday jump that we have seen since January. Bank of New York Mellon now trading at the highest price that we have seen since 2022. And just looking at some of the instant analyst reaction to these reports, RBC's Gerard Cassidy saying that the results were strong overall. He also noted that some of the main drivers, key metrics of this report were the better than expected non-interest income and also net interest income, in addition to lower than expected expense and loan loss provisions. So again, noting the fact that core EPS coming in ahead of estimates here, you're looking at a jump of just around 3.7%, and the stock now trading just shy of $64 a share.
Yeah, just trying to explain the best I can some of the key drivers here for this business as they had laid them out. Drivers of the total revenue, at least in the lines of businesses. They talk about asset servicing. Total revenue there was kind of flat year over year. Higher market values is what that really reflects. And so net new business, higher foreign exchange revenue offset by lower net interest income here. And that sequential increase, they said it primarily reflects higher foreign exchange revenue and net new business. And then the other one here, if that one didn't put you to sleep, issuer services here, the year over year increase primarily reflecting some of the corporate trust fees. This is a complex business, sometimes difficult to fully break down here, but all in, those key drivers really adding up to what investors are rewarding here, at least early here in trade. We'll see exactly where things net out and how they're able to add on to some of the EPS gains here. This very easy to take away, 16% year over year EPS improvement there. So that's something that investors are going to perhaps give a little bit more of a check mark to this morning, and they have.
Let's take a look at AT&T announcing nearly all of its customers, its mobile phone customers, calls and texts were exposed in a data breach back in 2022. Now, the hack also impacting a small number of customers in January of 2023. So this was an ongoing hack here, just to make that clear. Now, hackers stole 6 months worth of call and text message records and nearly every AT&T cellular network customer in this SEC filing. They said that they, quote, unlawfully accessed and copied AT&T call logs that were saved on a third-party cloud platform. Now, the third-party cloud platform, AT&T went on to say it was Snowflake. So if we could show Snowflake here, you're looking at shares fall as a result of that. Now, the data contains records of calls and texts between May and October 31st of 2022 and on January 2nd of 2023. So we're still getting more and more details about this breach, what the potential is here. But clearly the data that could be released and has been released within this report could be significant here just in terms of exposing call logs, exposing text messages for all those millions of customers here, Brad.
Yeah, I also want to take a look at seeing what shares of Verizon are doing, just with the thought process of whether or not this is an event that would actually cause so much churn to the point where it would be advantageous to one of the other companies, one of the other main companies that's in this telecom space. And taking a look at shares of VZ here on the day, I mean, they're only fractionally higher as of right now. But for both of these companies, making sure that they're investing so much in cybersecurity to make sure that all of the data that they house and the troves of data, whether that be on call logs, whether that be on some of the personal information that they have on customers and client accounts, especially as they're waiting for this new super cycle to be unlocked around the new devices that they're anticipating taking on and being able to add telecom services on top of later this year. It's a critical time for them to just retain existing users and making sure that they're not seeing an outsized amount of churn when you do have events like this take place, because that certainly is where much of the consumer mindset may drift towards and trying to figure out, okay, how do I just get away from some of the breaches that have taken place as well. Also, everyone, coming up, a deeper dive into big bank earnings. We've got analyst reaction on the other side of this short break. JPMorgan, Citi, and Wells Fargo all reporting earnings this morning. The key data points right here. Net interest income. That's all you got to remember. JPMorgan's profits surged 25% from a year ago, but net interest income fell for the second consecutive quarter by 1%. Wells Fargo sliding as its net interest income fell 9%, lowest level in 2 years, and Citi initially emerging as the winner this morning thanks to its wealth management business. Here with more, we've got Saul Martinez, who's the HSBC head of U.S. Financials Research here. And Saul, it's great to catch up with you, take some time this morning. First and foremost, perhaps for those trying to figure out why net interest income is such a big marker to keep tabs on for these banks, how much kind of weight do analysts and heads of research like yourself give that marker versus others this quarter?
Well, yeah, no, thanks for having me. It's really, really important for their banks. The bulk of revenues for most banks is net interest income. It is your interest income minus your interest expense, and that has been under some pressure for banks more recently in recent quarters. So as as interest rates rose, banks benefited from that. Most banks are asset sensitive, meaning their assets reprice quicker than their liabilities. But as the Fed has been on pause, the funding side of the equation has caught up, and it's caught up even as loan growth has been stagnant. So a major narrative and a major call for a lot of banks, and it depends to what degree this is going to be important. But the major positive case for a lot of banks is that you're close to seeing a trough in quarterly net interest income, and that in the back end of the year, you're going to start to see some sequential growth. And I think with this quarter, I think your general comment is right. I think the negative reaction, especially for Wells Fargo, who is more of a traditional bank, by the way, and maybe more like commercial banks and the regional banks who are going to report, they are still seeing some of those headwinds. Deposit costs are slowing the increase, but they're still increasing, and loan growth is still under some pressure. And Wells Fargo, I think there was some hope that they would increase their guidance of 7 to 9% decline. They said they were likely going to be at the high end of that decline. So it's not a surprise that Wells is underperforming. And the other thing here, though, is, and I think it is important to note, though, JPMorgan and Citigroup obviously are more diversified. They have more markets businesses. Those businesses did very, very well. And that is, I think probably the bigger takeaway is the markets business is doing substantially better than sort of traditional banking, at least with this first wave of results.
Yeah, so I know that this is just the first wave of results, but at least for the big banks that reported today, Citi was the only big bank that you had a buy rating on here this morning. When you take a look at Citi's report here, some on the street were taking a bit of an issue just in terms of, I guess, when you look underneath the hood at some of the weakness that we did see within Citi, but overall, it looks like the street reacting positively to this report. I'm curious, does this then strengthen, do you think, your base case? Or actually, look, now it's down up just about 2%. Do you still think, are you as confident here that Citi is among the best positioned, at least at current valuation levels?
Yeah, I do. I think, they're net, we think, I think we termed it mostly positive initial take. And I think that's, as you kind of look through the results, investment banking, very strong, sales and trading, very strong. The wealth management business, which is going to be really important for a turnaround, that did well. Credit quality was resilient. There were some concerns about some of their credit card credit quality, especially in the retail services business. That seems to be holding in. So a lot of good things there. I think where you can take issue, if you look at net interest income, and this gets into the weeds a little bit, but if you look at net interest income, excluding sort of the volatile markets related components to it, it did decline sequentially a bit. So that is, and there is some question about how sustainable the strength in investment banking is, and I think that's true for a lot of folks. And so it is sort of a mixed, result. But I would say net positive, especially given at these valuations, especially given the view that you're coming from a low ROTCE. The bar is low for Citi. If they can get to closer to 10% over the next couple of years at these valuations, there is considerable upside. So I think it reinforces the thesis, but it's not universally positive either. And I think that's why you're seeing a bit of volatility and the reaction there.
So we only got about 30 seconds left. I'm wondering, from your purview, what is loan demand telling us right now about either the strength of the consumer or even the strength of small businesses?
Yeah, I mean, I think, I know we don't have a lot of time, but I think on the commercial side, the limited loan growth does reflect restrictive monetary policy to some degree. What you hear a lot is corporates are not using lines of credit. Those are priced off short-term interest rates, and short-term interest rates are high. So the demand and the utilization remains low, and that's a headwind. For cards, it's still growing on the consumer side. Credit cards are still growing disproportionately fast, but it is moderating. It is moderating versus elevated levels. So I think you're seeing, it's telling the broader, I think it's reinforcing the broader narrative that we are seeing a slowdown, but the economy is generally pretty resilient. And you see that in terms of credit quality as well.
Saul, great to speak with you here this morning.
Yeah.
Saul Martinez, who's the head of U.S. financial research over at HSBC. Have a great weekend, Saul.
You too.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching the Morning Brief.
Traders have been piling into small caps and dumping big tech, at least over the last couple of trading days. The Russell 2000 climbing higher once again this morning. You're looking at a gain of just about 5% since the start of the week. Now that move higher coming on the heels of Thursday's CPI data that showed signs of cooling inflation, and that really sparked a rotation in some of the laggards that we have seen since the start of the year. And as a result, we saw a number of larger cap tech companies under pressure. This rotation into small caps, and really the theory behind it, Brad, is because of what we just said about cooling inflation. Now, we have been waiting for this more of a broadening within market participation. This rotation into small caps, similar to the moves that we saw towards the end of last year, when there was lots of optimism that the Fed was going to issue its first rate cut. So here we are in the back half of 2024, and now it seems like the narrative is starting to shift just a bit when you couple some of Powell's recent commentary about the progress that we have made on inflation and square that with at least that CPI print that we got yesterday. PPI maybe pouring a bit of cold water on some of that progress. We'll see how that all shakes out in the PCE report that we will be getting soon. But again, that progress on inflation, enough here for the street to get even more optimistic about rate cuts, and we're starting to see a bit of a rotation. Now we'll see whether or not we'll see a bit more of momentum within some of those smaller cap names, because as you can see, even if you take a look more of that year-to-date performance, Russell 2000 still significantly lagging the S&P 500. So you could make the case that maybe we are setting up here to see more of a catch-up trade happen in the next couple of months.
Yeah, in terms of the commentary of the past 5 days, I think back to our conversation with Liz Ann Saunders from Charles Schwab, who was talking about some of the quality bias that still exists in terms of what's working and what's not, and doing profitability ranges even on some of these small cap names. And that's particularly acute within the Russell 2000, where the profitable stocks have done very well. Low interest coverage stocks have not kind of maintained these strong balance sheet. So ultimately, the profitable stocks doing well over the past year, the unprofitable stocks doing quite poorly, and really the differentiation between those. And she was saying, look at it in terms of interest coverage. High interest coverage stocks done very well. Low interest coverage stocks have not had strong balance sheet companies versus those weak balance sheet companies, and the big performance spread that she had been tracking there, which really kind of gives us a little bit more color about what's performing well within the small and mid cap space right now.
All right, we'll keep it right here. We've got much more coming up ahead. Consumer sentiment data at the top of the 10 a.m. hour. We will cover much more of that ahead on Catalyst.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
We're getting in a fresh read on the consumer with consumer sentiment data that is just crossing the wire here right now, looking like it is coming in initially a little bit soft. We're going to dig into all of the numbers for you and what that signals about our economy.
All right, JPMorgan, Wells Fargo, and Citi kicking off earnings season with a mixed picture here. We will discuss what these results signal for the broader macro landscape.
And of course, returning to Washington because President Biden wrapping up the NATO summit, focusing in on foreign policy. That was his latest effort to recover from the post-debate pressure that has been mounting on his presidential campaign. The RNC kicking off on Monday. We'll discuss what's next for both presidential candidates.
All right, we want to kick it off with some breaking news that we have in consumer sentiment. The data coming in just below here what we saw the previous month here for July, falling to 66 flat. That was down from 68.2 the prior month. In terms of expectations index, that fell to 67.2 versus 69.6 the prior month. Expected change in median prices during the next year, that actually declined to 2.9%, that falling from 3% expectations. And expected change in median prices during the next 5 to 10 years there, so a longer outlook there, falling to 2.9%. So again, a bit of a shift down here in consumer sentiment. We're seeing that reflected here in the markets just a bit here, right around at the top of the hour, Maddie.
Yeah, certainly an unexpected decline. Consumer sentiment falling to an 8-month low here as these higher prices continuing to weigh on American consumers. You're looking at broader gains across all the major indices here, perhaps a digestion of this data following that hotter than expected PPI, with folks going back to yesterday's takeaways from CPI and, of course, the labor data, maybe pricing in a higher chance of Fed rate cuts to come sooner than expected off of this inflation data that we are getting in right here. This also, of course, comes as unemployment rose above that key 4% level back in June, another potential reason for the Fed to kind of cling to be able to cut back on rates sooner than potentially expected. Well, we're going to continue the conversation around consumer sentiment here. And of course, another recent economic data point that we've been getting in with our guest. We've got Mike Reynolds. He's the VP of Investment Strategy at Glenmead right here on set with us. Thank you so much for coming in. So these consumer sentiment numbers obviously falling to the downside here significantly, given that it's the biggest fall in the past 8 months and getting a big reaction in equities. What's your take?
Yeah, we watch the consumer sentiment data really closely, but one of the things we've noticed over the past year or so is consumers are telling survey pollsters one thing, but then going out and doing different things with their wallet. So while we've had recession-like readings on consumer sentiment, retail sales, while not really sort of hitting it out of the park, have actually been relatively robust, both on a real and a nominal basis. So we're kind of looking skeptically at consumer sentiment numbers now. We're seeing in a lot of cases consumers are sensitive to price levels, but we know inflation has actually been getting a little bit better over the last few months. So in general, we don't think that this is, the bottom falling out for the consumer, and the consumer is actually going to hold up pretty well.
What do you think of the inflation readings that we got? We had PPI out this morning coming in slightly hotter than expected, but CPI print, we certainly saw that reaction play out in the markets. Lots of talk about this does really reinforce maybe we are going to see a rate cut in September. What are your expectations at this point in terms of what likely action we'll see from the Fed between now and year end?
Yeah, the big focus is on yesterday's CPI. I mean, the PPI has more of a loose relationship with actual prices, but we were very focused on the CPI yesterday. And really, Goldilocks had her day. It really pushed all the right buttons. We saw services looking flat month over month. We saw the headline actually showing deflation, goods deflation. So really, all of the things the Fed was looking for to happen basically came on script. So what does that mean for the Fed, though? We think that September is now a truly live meeting where we can expect rate cuts. That's our base case if we continue to see further progress on inflation. It's kind of like a game of tic-tac-toe. If you have 2 in a row, you don't win. You need that 3rd in a row, or perhaps even maybe more, to give the Fed confidence that inflation's moving in the right direction. And then the Fed can then focus on both sides of their dual mandate. They can look at inflation as well as employment to make a more guided decision on what's the appropriate level of rates. We think base case back half of this year is 2 to 3 rate cuts going into next year. Possibly 3. Yes, we're raising the odds. It's not the base case, but it's on the table now.
What would prompt the Fed to cut 3 times, do you think?
If we get inflation continuing to report as it did, the last 2 months, and you get that through the summer, they're going to take August off, so they get 2 more of those heading into September. That could set up a situation where we get 1 rate cut for basically each meeting September through December. If, again, they're confident that inflation is moving in the right direction. But again, the focus then, if inflation has been conquered, it's going to be now looking at the labor market. And if there are more signs of trouble there, that could perhaps get the Fed on board with a more consistent rate cut cycle into the end of this year.
But this is a central bank that really likes to be clear about their intentions. And they've not given us any sign from their mouths that they plan on cutting 3 times this year.
Things can change very quickly. If you look at where we were at the beginning of this year versus where we are now, we're certainly not at the same point in terms of what the Fed is telegraphing is the likely path for rates. They're going to react in real time to this inflation data, as are market participants. So expect throughout the summer, if inflation is moving in the right direction pretty materially, we could start to see them sing a little bit of a different song.
What about the risk, though, of cutting too close to the election and maybe what that signals? Because we've talked about that a lot with economists and strategists here over the last several weeks, saying that they really want to distance themselves from that November election. It doesn't really sound like you think that the Fed is too concerned with that.
Yeah, we hear some of that chatter, and I'm not sure we're buying it. There are a lot of examples throughout history where the Fed has cut or raised rates in election year, even the months around election. We think they're ultimately going to do what's best for the economy. That's their mandate, and we have no reason otherwise to suggest they'd do anything different.
I want to talk about equities before we let you go. Yesterday, we saw the beginnings of this rotation, a lot of pressure on large cap tech, and obviously we're seeing a lot of upside movement after this sentiment data coming in. What do you think the right thesis is for investors as they're watching this economic data coming in? How should they be positioning around economic data to come?
The thesis in this environment is rotation. We've seen after the last 2 CPI reports, basically look at how the market opened right after. Small caps were up a lot. And that's a part of the equity stack that hasn't participated in this ongoing bull market, that has a bit of a catch-up trade. We're looking at fair valuations on small caps versus more expensive valuations on large caps. Valuations by themselves aren't a great timing mechanism, but it's perhaps more confidence that the Fed is going to be able to cut this year that's really getting people excited about small caps, particularly because small caps have a larger share of their debt in floating rate loans, so they're going to be more directly sensitive to the Fed rate cut decision.
All right, Mike Reynolds, Vice President of Investment Strategy at Glee. Thanks so much for joining us here in studio today.
Happy to be here.
All right, President Biden wrapping up the 3-day NATO summit this week with a press conference where he tried his best to reassure the masses that he is staying in the race. And President Biden didn't shy away from addressing former President Trump, at one point saying, quote, "Where's Trump been? Riding on his golf cart, filling out his scorecard before he hits the ball." Well, the focus will be on former President Trump next week, as he's expected to announce his vice president pick at the Republican National Convention, which kicks off on Monday. Joining us now is our very own Rick Newman. And Rick, last hour we were focused a lot about President Biden and where that and I guess how that has played out this week, clearly really driving the conversation surrounding the 2024 election. But what about President Trump next week? What are we expecting to hear at the convention?
Well, as you point out, I mean, the big bit of suspense in the Trump campaign is who is his vice presidential pick going to be? And then once we know who it is, we won't care. I mean, just to remind everybody, I mean, this is the last bit of suspense in the Trump campaign for a while. And Trump has been strangely silent, for him anyway, during the last 2 weeks, sort of letting the press chew up Joe Biden after his terrible debate performance. So, I mean, the reporting on this is it's down to 3 people probably. There could be a surprise, but Doug Burgum, who's the sort of person, the governor of North Dakota, who no one has really heard of until now, Marco Rubio, the senator from Florida, possibly J.D. Vance, the senator from Ohio. And the way I think about this is in 2016, Mike Pence probably did help Trump a little bit with the evangelical vote, because Pence is an evangelical, and Trump is not a natural person for evangelicals to get behind, okay? And at least he wasn't then, and I think he still isn't now. So he's not going to have that this time around, based on the reporting on who the possible VP picks are. So what is his VP pick going to do for him? I'm not really sure it'll do anything for him. Marco Rubio could perhaps help get more Hispanics to vote for Trump. But Rubio's from Florida, that's already a red state. J.D. Vance from Ohio, also a red state. Doug Burgum from North Dakota, also a red state. So I'm not sure if those are the picks. Now, it could be somebody else. But if it's one of those people, I'm just not sure that juices the Trump campaign very much. I guess I would add one more thing. Everybody's so focused on how old Joe Biden is, and important to know is his vice president up to taking the job if he can't. Same is true for Trump. I mean, Trump is 78, so you have to think the same thing about his vice president, whoever it turns out to be. It has to be somebody. At least voters will think, well, if that guy or woman has to step in, he or she would be able to do it.
It points to something I've been asking you about, Rick, which is the strategy behind who we're putting on the ticket, right? And
you think there's a strategy? Oh, okay.
Well, I mean, that's the question. We had some reporting from other outlets this morning talking about how major Democrats are frustrated that there wasn't more clarity from the White House about Biden's age slips. Yep. But we all knew that this was a question 4 years ago. I don't understand that continued talking point.
Well, I mean, I made a joke about is there a strategy, but there is no strategy on the Democratic side about who the candidate should be. It's Joe Biden. I mean, and that's normal. I mean, if an incumbent president wants to run for re-election, he runs for re-election, and you can't argue it. I mean, you know, Lyndon Johnson dropped out in 1968 because of the Vietnam War. He just decided that he had to go, and he probably would lose if he ran. The Democrats ended up losing anyway. So that was one instance where but remember, in that case, the incumbent chose to withdraw. Yeah. The party didn't say you got to go. The incumbent chose. And just, I mean, honestly, as long as Joe Biden, I mean, he could be senile, and as long as he is saying, I'm running, he's running. I mean, it's really hard to derail an incumbent who says, I'm running. Now, Biden hinted at this press conference yesterday. We got different language out of Biden yesterday. So number one, he demonstrated that he is aware of everything we're all saying. He's not, you know, completely insulated from all of these concerns. He even kind of suggested that, I mean, I think the way he phrased it was, if the right people come to him and tell him he needs to withdraw, then maybe he might listen to them. I guess the right people include his wife, Jill Biden, and other family members, and I'm not sure who else counts. But Biden's it until he decides not to be.
I also want to quickly ask you about how this impacts the broader election space. How much does this kind of back and forth squabbling impact the potential for Republican sweep heading into November?
I mean, the big thing, the big problem that Democrats have right now is we are not talking about Donald Trump and what Donald Trump's vulnerabilities and foibles might be. The Biden campaign is trying like mad. I mean, they're running ads, they keep putting out press releases talking about this plan, the 2020 Project 2025 plan at the Heritage Foundation, which is to like completely remake the whole government of the United States into some kind of like conservative movement, get rid of half the civil service and do all these things. Biden they are trying to get the message back on what they say are all the terrible things Trump would do. That's not where we're at right now. Just to push this forward into the fall, I think by the end of August, we are going to know it's either going to be Joe Biden or it's going to be somebody else. And at that point, it's going to have to be final unless there's a health emergency. And then probably we will be talking more about the issues, or maybe we will, and less about Biden's age. But that all depends on how Biden performs. You know, he showed us a little more vulnerability yesterday. I think that needs to continue. He needs to, you know, he said, for example, you know, I hurt my foot. I didn't wear the boot when I broke my foot or something like that, and that's why I'm kind of walking around with this shaky foot. I mean, I didn't know that until he said it. If he is a little more forthcoming and he keeps passing, if he can pass the test every time he talks in public, I don't know that he can, but then we will be talking more about issues and less about Biden. But unfortunately for him, he's not getting younger. He's only getting older.
What do you think the strategy should be to blunt some of the inroads that former President Trump has really made? It seems like, at least from the polling with the younger voters and minority voters. I guess, is there a strategy there? And is there confidence that President Biden will be able to do that? Or would that really need to come from some of the other possible candidates that have been floated if he were to step aside?
Well, I mean, what the Biden campaign would love to do is get this this election back on the issues that they think are winning issues for them. Abortion. I mean, when the Supreme Court overturned Roe v. Wade last year, I mean, a lot of analysts thought, oh, Republicans are toast in the next, X number of elections. The Democrats want to get back there. Really, I think this is also really important, overlooked at the moment. The quality of the campaign that each candidate runs is also hugely important. Just remember, we're talking about 6 or 7 swing states, swing voters in swing states, and turnout. I mean, everybody knows this in the campaigns. Turnout in places like Philadelphia, Milwaukee, and Detroit is absolutely crucial. And if the Biden campaign can get high turnout in those cities, those are mostly Democratic voters, and that'd be good for them. So Biden did make a point. No one's paying attention to this. He said we have more than 1,000 offices. We have all these volunteers. The quality of the they call it ground campaign really matters when it's coming down to small numbers of votes in swing districts and swing states. So to some extent, getting people who are inclined to vote for Biden, just getting them out to vote in the first place, is what the Biden campaign needs to be doing.
All right, Rick Newman, always great to talk to you. Thanks so much
Thanks,
for joining
guys.
us here this morning. All right, keep it right here on Yahoo Finance. We've got much more of your market action ahead. Again, we're just about 47 minutes into the trading day. You're looking at gains across the board for the 3 major averages. You got the NASDAQ leading the way, up just around 0.7%. Much more on Catalyst ahead.
get to some trending tickers that we're watching here. Tesla snapping its winning streak. Shares are actually moving to the upside this morning. It's up over 2.5%, but this comes after Bloomberg did report that the company is delaying the unveiling of its robo-taxi by 2 months. Now, this comes as the stock is coming off an 11-day rally that was sparked by better than expected delivery numbers for the second quarter. That jump initially wiping out the stock's losses for the year, then moving back into negative territory for 2024 after yesterday's losses, and now we are seeing the stock moving back to the upside this morning. So for now, we are going to bring in Jessica Howe, Guggenheim Securities Director. This is Ron. Sorry about that, Ron, my read there. Director of Automotive Equity Research for more. Ron, thanks so much for joining us here. So it's interesting to me, this reaction, given what we know about the robo-taxis here. Is this the latest indication of the facts and fundamentals of Tesla not necessarily being the key driver of the stock?
Yeah, I think that's probably fair. I would point out today specifically that the entire EV space is moving to the upside quite a bit. I think there's probably some either short covering or some squeeze dynamics going on today. But yeah, related to the robo-taxi event specifically, I think the issues yesterday and why it was such a pronounced decline for the stock was, I think it's important to think about the genesis of the robo-taxi event. It was during Tesla's significant downward move in the first quarter of this year when there was a report that they were delaying or canceling the next generation platform. And that same day was when the robo-taxi event was announced. I think by some investors, it has been viewed as a bit of a defensive or a massive pivot, at least for the company, away from affordable EV models in the future to robo-taxis. And to the extent that they lack some credibility there, which I think a delay at least leads people to believe, that is an issue for the stock. It was also just very overextended, I think, coming off the rally post deliveries and the energy deployments.
Ron, how confident are you that we actually are going to see robo-taxis from Tesla one day?
One day is a very long timeline. So I would say I'm more confident than not in one day. I would say prior to 2030 at any scale, I think is very unlikely. I would expect testing to be done before 2030 to the extent they're serious about this as a project, which they certainly seem to be now. So I would say post 2030 is when this is a meaningful contributor to the business, and I would say even probably well into the 2030s before this is really at scale.
Tesla's 30-day volatility is really outpacing other car makers in the space. Does the volatility around Tesla make it a better play for day traders than investors?
Yeah, I wouldn't say we talk to a lot of day traders, so I don't have a ton of perspective on this, but I would say post the delivery and energy deployments number, there has been a consensus view in the market, both among, I would say, long only and long short investors, that this was a very difficult stock to be underweight or short into the robo-taxi event. You have summer trading dynamics, a heavy retail interest in this stock. So there were a lot of investors on the negative side that had stepped aside both before deliveries and after deliveries. So I think a lot of this move post deliveries has actually been driven by retail buying. And I think if you looked at a stock chart that looks like this historically, algorithmic trading tends to kick in as well to the upside. But that is a bit out of my purview, so I'll try and stay in my lane.
Ron, let's talk about the presidential election. Hopefully that is in your purview and something that you can comment on it just in terms of what this means for the EV industry and specifically Tesla. Because when we talk about the potential and possibility of a Trump presidency, of course, many of our viewers and investors out there think about what exactly that could mean in terms of the rollback of EV subsidies. I'm curious, if we were to see Trump elected in November, what are the implications then for Tesla?
Yeah, it's a good question. It's one that's come up a lot recently. I think people trying to make sense of Tesla's move to the upside if there is some perceived Trump benefit for the stock, and I know there's been some noise about that in the market. We really struggle to see this as a benefit to the extent Trump's elected. You mentioned the $7,500 credits at risk, which is a key affordability enabler for Tesla vehicles. Also, the Chinese batteries potentially seeing higher tariffs. Tesla's lowest price models in the U.S. do use Chinese source batteries, as do other manufacturers. Tesla's not unique there. And at the end of the day, this was a rising tide lifts all boats scenario. I think the analog to that to the downside is a receding tide. It doesn't necessarily sink Tesla's ship, but it does sink some ships, and it's certainly negative for everyone. But ultimately, Tesla had more benefit from the IRA than any corporation in the world as a percentage of revenue.
Ron, whose ship does it sink?
Tough to see this as a positive. I'm not getting into whose ship it might sink, but it'd be pretty negative for EV manufacturers that are struggling to turn a profit today.
Yeah. So off of that, then, at least for Tesla, could it at least maybe put them in a better position than others, given the strength that they do have, given the fact that they are profitable, given their market share, that maybe they are able to weather the storm a bit better than some of the others within the marketplace?
Yeah, the relative argument, I think, is where the perceived Trump benefit comes from for Tesla. I think that ultimately it's a net negative for everyone. Even if Tesla is relatively better, it's still negative. And we actually struggle to see that just looking at the percentage of revenue that benefits for Tesla. It's dramatically higher than anyone else. But they would still be structurally profitable, so as a going concern, certainly it's better positioned, but the stock is certainly priced well beyond what a going concern would be at this point. And at the end of the day, the only other positive I've heard is that it does push out the risk of Chinese manufacturers coming to the U.S. I would say that most people in the auto industry don't view the Chinese local manufacturers coming to the U.S. as a real risk. I think it's one thing that both political parties actually agree on is protecting the U.S. auto industry. So I think that's a very low risk at the end of the day.
Just to get a little bit more clarity on that, Ron, do former President Trump's proposed tariffs on China does that purport a risk to car makers here in the U.S. because of the inflationary impact, or are you saying that that risk is overblown? Give me some clarity on that.
Yeah, no, I think that it does hurt their cost of goods sold because the lowest price models for many manufacturers use Chinese-based what's called LFP batteries because that is the lowest cost battery in the world today. So it's a risk to profitability for all EV manufacturers. It does push out the risk that BYD and others would be able to import cars into the U.S. profitably. So it does, I guess, decrease the competitive risk over time. But BYD said publicly they have no plans to come to the U.S. anytime soon. I don't think there was a real risk that was ever discounted in this stock. So from a stock perspective, hurting the affordability of Tesla's most affordable model, making it more expensive to produce is a net negative, which is what the China tariffs have done.
Ron, it's always good to have you. Thanks so much for hopping on with us here this morning. Have a great weekend.
Thanks, you as well.
All right, let's stick with Elon Musk and talk about another headline that's catching our attention here this morning, and that's the EU is back at it again, and this time targeting Elon Musk's X, the European Commission accusing X of deceiving users and infringing digital content rules. The investigation finding that X has broken rules regarding dark patterns, advertising transparency, and data access for researchers. And I think when you take a step back, the big reason why we are talking about this is just the EU's, I guess, getting more aggressive with U.S. companies when you talk about the targeting, what has been going on with big tech, whether or not it's warranted. I think that is out for debate up right now. But again, this latest here coming in what has been a busy couple of weeks for the EU in cracking down on some of these tech companies here in the U.S., this time accusing X of deceiving users here, Maddie, and also breaching online content rules.
Yeah, that's exactly right, Shauna. I was not really familiar with the marketing term dark practices, so just looking into that, like basically deceptively getting people to sign up for a service that's difficult to cancel, doing something that you would not be able to or interested necessarily in doing. That's what a dark pattern is in advertising. So that is what X is getting dinged for. Now, what's really interesting to me is the potential financial impact. If the commission's views on this are confirmed, X could be facing a fine of up to 6% of its global annual revenue. And as you were mentioning, Shauna, this comes on the heels of a slew of investigations from the EU. This commission also investigating TikTok, Alibaba, AliExpress, Meta over other concerns. And then also this comes on the heels of a slew of other investigations from the Digital Services Act that really began back in about 2022, I would say, with regards to the big tech companies that we think about stateside with Google, Meta. Questions still remaining about the degree to which we might see regulatory action stateside in response to this. I think when it comes to X and Elon Musk, this mirrors something that I heard another tech executive executives say to me earlier this week, which is that it's the latest distraction for someone who this investor I was speaking with said that he just wants Elon Musk focusing on Tesla. So another concern for Elon Musk to think about here. But we're going to move on. We're going to talk about shares of Carvana. They are moving higher this morning. This comes after BTIG initiated coverage of the stock with a buy rating. Analyst Marvin Fong saying the stock is in a uniquely well-off position. So here to explain, we've got Yahoo Finance's expert in the space, Praz Subramanian, joining us. Praz, great to have you as always. So this BTIG initiation here obviously leading to some positive gains in the stock. What can you tell us?
Yeah, it's a nice kind of turnaround story here for Carvana. I mean, from the depths of the abyss that the stock was once trading at, you have a long-term chart, you can see how low it had gotten at some point, but now doing quite well here. Marvin Fong also adding a $155 price target here. It says more upside to come for the stock. Interesting quote here. He says, "We believe Carvana's vertically integrated and in-sourced business model is simply a better mousetrap in an enormous addressable market that investors shouldn't overlook." He says he likes Carvana here more than CarMax because of the profitability efficiencies there with selling cars online versus having a massive retail footprint there. So that's interesting there. But I got to note that this is happening along the backdrop of a lot of weakness in the used car market.
Yeah, so what are we seeing there? Because we have seen a bit of an, improvement customer-wise in terms of the drop that we are seeing in sales. What's driving that? Is that mostly supply-based, do you think, in terms of that movement?
I think so. I mean, pre-pandemic, during the pandemic, we had a massive skyrocket in prices paid for used cars, like just an enormous amount of money. Used cars weren't even losing value for a couple of years. You'd buy a car and sell it a year later and not lose any money. That's changed a lot, especially with the CPI reading yesterday. A big month-over-month drop and a big year-over-year drop there. Also, Manheim, which tracks the kind of the used car wholesale market, that market has been steadily declining. Again, declined in June as well. So maybe some normalcy here, but I think there might be sort of an overcorrection perhaps, and there's so much supply out there. People aren't buying cars right now in the summer. The spring is usually the big buying season, and the fall right now it's kind of a dead zone. So you're seeing a lot of maybe good deals, but also financing costs are still high, so dealers got to come down in price to move products. So I think that's sort of a problem, and I think for Carvana that could be an issue, right, if they're seeing a lot of used car supply out there right now.
Does that make right now a good time to consider buying because you've got summer, you've got being on the heels of rate cuts, so maybe prices are a little more negotiable? Yeah,
I mean, we've talked about that with regards to EVs because you still have this EV tax credit that now you can actually get a point of sale credit there for that. We've seen it's possibility that if Trump is elected, we might not see Ron is talking about, we might not see the tax credit in the fall. So this is probably your best time to buy not only just a used car, but maybe a used EV.
All right, Praz, well, thank you so much as always for joining us. We appreciate it. Coming up here, we're going to talk producer prices unexpectedly rising here in June, but consumer sentiment falling down to the downside. We're going to talk about the indices seeing the most increases on response to that news next on Catalysts. President Biden's command of foreign policy issues was on display at the NATO summit, but perhaps overshadowed by his mixed performance in his remarks. To break it all down, we're going to bring in Ivo Daalder, Chicago Council on Global Affairs CEO and a former U.S. ambassador to NATO. Ivo, thanks so much for being here with us today. Obviously, you understand NATO intimately. What was your single biggest takeaway from how President Biden was able to position himself this week, both throughout the summit and then, of course, in his remarks?
Well, this is clearly a president who knows what NATO is all about, who understands the importance of alliances, and who understands how vital NATO is to American security. I think you saw him display his knowledge and grasp of the issues. Sometimes not as fluently as some people might wish or want, but definitely fully in command. And I think there's a contrast here. If you compare the president's speech, the one he did to celebrate the 75th anniversary, which opened up the summit on Tuesday, compared to remarks that former President Trump made a few hours later, you see the difference. There is one candidate who, like every president since Harry S. Truman, understands the vital importance of this most successful military alliance, and there's another who admitted that until he became president hadn't really heard of NATO. And that's a contrast that matters, and it's the one, when I was in Washington this whole entire week, it's the one that allies are most focused on. They don't really focus on the age and the issues that have so beset Washington. They focus on who's going to be the leader of NATO. Is it going to be Donald Trump, who doesn't seem to care much about it, or is it going to be somebody like President Biden, who will do the same as every predecessor from Truman through Obama did, believe that NATO is important?
Are they confident in President Biden and his ability to serve another 4 years?
They don't express that. This is not the kind of issue that foreign leaders make clear. But what they have said, and which is very clear, they want a leader like President Obama who believes in NATO. And clearly the fear that he would lose the election and that Donald Trump would win is a motivating force for them in many, many ways. They're hedging their bets. They're trying to figure out how to deal with Donald Trump. They did it for 4 years, but this, they realize, is going to be a different Donald Trump, unleashed and unmarked.
It's interesting. I know you recently wrote about how former President Trump's supporters think about his positioning on NATO. You noted, for example, that only 35% of Trump Republicans do believe that NATO cooperation does make the U.S. safer. What do you think is missing from the current administration's messaging about the importance of NATO that could potentially shift that 35% folks, shift their thinking on that?
Yeah, I don't think that's going to be easy to shift their thinking. I think the more important message, and this is an opinion poll that we, the Chicago Council, just released last week, 2/3 of Americans think that NATO is essential to U.S. security. And there is a growing political divide, particularly among those Republicans who have a very favorable view of Donald Trump, which is about half the Republican voters in our poll. They seem to be following the president down the path of believing that NATO is not very important. They're certainly on my Twitter feed, I can tell you that. But it is the overwhelming majority of Democrats, independents, and non-Trump Republicans who fundamentally believe that NATO not only is essential, but also makes the United States much safer. And I think the administration is concentrating on that voting bloc, as it should, because that's the majority of the Americans.
So what do you see as the biggest future challenges when you talk about how the relationship has evolved and improved clearly under the Biden administration compared to the rhetoric that we heard from former President Trump? Where do the relations go from here? Just given all of the uncertainty, what are the next? I know that this is a bit of a loaded question, but what do the next several months look like in terms of our relations with our key European allies, given the uncertainty and given the fact that this could, quote unquote, all fall apart if we do see another Trump presidency?
So I don't think you're going to see a lot of change in the next couple of months, but I do think there is a new trend. And the trend line is that the Europeans are stepping up, as they should. And as every president since Harry Truman has urged them to do more for their own defense. And I think one of the things we were celebrating and seeing here at the NATO summit was the fact that European defense spending is increasing significantly. 23 countries now meet the 2% of GDP requirement for spending on defense. NATO Europe as a whole is spending 2% of GDP on defense. The total amount of money that Europeans are spending on defense is $500 billion a year. That's a significant amount of money. It's about 3 times, if not 4 times, as much as Russia spends. And I think what you were going to continue to see, whoever is president, effort by the Europeans that needs to be supported by the United States to build a stronger European pillar, a defense industrial pillar, as well as a defense capabilities pillar within the NATO alliance, not as a competitor to NATO, not as a competitor to the United States, but within the NATO alliance. And I think that's the focus that comes out of this Washington summit that will motivate Europeans, perhaps even more if Donald Trump were to be president. But nevertheless, it's in our interest that Europe do more, take more responsibility, share more of the burden, and as a result, add to global security by just being part of the game.
I want to end by specifically asking you about Ukraine. We had several global leaders in NATO this week who have either been weakened, like a Macron, being challenged by their own party, like a President Biden. And then, of course, just the broader global shift to far-right policies. To what extent do you see that being a headwind for Ukraine as this war continues?
Well, clearly, the far-right forces within Europe, as indeed in the United States, are skeptical about Ukraine. They seem to align much more with Putin and Russia, which is in part the fear that I think we should all have about these forces. But at the same time, I think the summit once again reaffirmed a fundamental understanding that every government has, with perhaps the exception of Viktor Orban's Hungary, that what is happening in Ukraine is existential, not just for Ukraine, but indeed for European security and for NATO. That if Russia were to succeed in subjugating Ukraine, in finding a way to tell Ukraine that it is no longer an independent country that can make its own sovereign decisions, that will lead Russia to try to probe not just non-NATO territory, but NATO territory members. And that's already happening with assassination attempts and the kind of things we're seeing the Russians doing.
Ivo, really quickly, since you mentioned Orban, he is visiting Trump today, representing Hungary, of course, which is on the border of Ukraine. What does that tell you about what the Ukraine situation could look like under a potential return of Trump to the White House, given that they're meeting today?
Well, U.S. military support for Ukraine is absolutely critical. Before the supplemental was passed, the $61 billion supplemental in late May, the NATO Supreme Allied Commander, General Cavoli, estimated that the war would be lost by this time, that we would have significant problems. The military supplemental was absolutely critical. And one of the key questions is that Viktor Orban doesn't believe in militarily helping Ukraine. And Donald Trump doesn't seem to believe to helping militarily Ukraine. And I think that does not bode well for Ukraine, and it does not bode well for European and NATO security, and therefore for our security.
Ivo Dozler, great to get your perspective here this morning. Thanks so much for making the time to join us. Chicago Council on Global Affairs CEO and former U.S. Ambassador to NATO. Thanks again.
My pleasure.
Keep right here on Yahoo Finance. We've got much more of your market action ahead. Just over an hour into the trading day, you're still looking at gains across the board. The Dow now up just over 200 points. You've got the NASDAQ up over 1% today, so recouping some of yesterday's losses when we did see underperformance from the Mag 7 stock. So a bit of a shift back to those larger cap names. Much more on the other side. U.S. producer prices are rising more than expected in June. They were up 0.2% on a month-over-month basis. When you compare it to the levels a year ago, it was up 2.6%. Here to take a deep dive into the report and really how it stacks up versus the global macro perspective, I want to bring in Daniela Costa, head of the European Capital Goods team for Goldman Sachs Global Investment Research. Daniela, it's great to talk to you. So here we have the latest PPI print here in the U.S. showing a rise here, at least more than expected in terms of those forecast numbers. I'm curious the trends that you have noticed on the inflationary front here in the U.S., how that's stacking up to the inflationary forces from a global macro perspective.
Hi, Sienna. Absolutely. So I think the trend that we have seen in Europe and in the U.S. has actually been pretty similar in terms of directional trends. We had obviously post the pandemic a very strong rise on the producer price indexes across manufacturing, aerospace and defense, so most of the cyclical areas. And they probably peaked around sort of the end of 22. And then since then, they've been continuing to be positive year on year, but slowing down in the rate of magnitude. And especially at the beginning of this year, both in the US and in Europe, they hit the run rate of the last 20 years on low single digits. People have been anxious about this because in terms of volume indexes, you look at the PMIs and the ISM, and they have been in contraction territory in recent months. And this has started to generate a debate globally in both sides of the developed world regarding if volumes are weak, what will happen to prices? Can we move into a more deflationary environment? And in the last 2 months, both in Europe and the US, we actually have seen things sequentially picking up again, still at much lower levels than we had in 22 and for the most part of 23, but slightly above the long run average as we see today. The one exception to this has been obviously in China, where we have not really seen this level of price inflation, and partly because the excess capacity in some of these manufacturing areas has been more prevalent and growth has lagged expectations, but it hasn't really had in the manufacturing world a contagion to the US and to Europe.
Daniela, when we talk about the recovery that we are starting to see in China, I think there's just more and more of that conversation as to how that is going to maybe feed through on a global scale. Are we starting to see any signs of that? Or I guess how big of a risk is that could in fact kind of reverse some of the progress that we have seen when it comes to the improvement or efforts here to tame inflation?
Yeah, I mean, as it takes on from an industrial world, actually, I think some of the weak data that we have seen, particularly in Europe, where many of the big manufacturers are importantly dependent on China, I think the worry has actually been more that if that growth is not there, what are we going to see? Are we going to see excess capacity, and will we actually move into a deflationary territory in industrials, which we haven't been for a while? So a recovery in China is probably welcomed at this point. It's also, I think, welcomed in the fact that local domestic utilization needs to increase in several sectors. So, for example, at the moment, inventories across general industrial in China, according to some of our data, are still 20% above normal. So you're still in a situation where the risks towards domestic downside are bigger. And if we do see that capacity getting used in China, there will also be less worries that emerge of competition from Chinese companies elsewhere. So that's where I'll put it.
So, Daniela, I'm curious just about the consumer sentiment surrounding inflation globally. Obviously, in the U.S., we got consumer sentiment data in this morning showing that consumers are feeling negatively about the inflation picture, that data coming in softer than anticipated. Where are you seeing consumers around the world the happiest with their central bank's handling of inflation?
Yeah, I mean, I sit on the industrial side, so I think harder for me to comment directly on the consumer. But what I would say, sort of, we see the picture is, I mean, in terms of actually the data points that we track in consumer, they have been sort of slightly off the bottoms on our global data maps. But I think to the extent that this links with what we are seeing, the different trends, as you mentioned, that we are seeing in sort of a bit on the CPI and the PPI. In terms of industrials, the companies that sit in has those intermediaries, they tend to have pretty good pricing power. If you look back up to the the last 20 years, it was really only in 2009 that we have seen these industrial producer prices across manufacturing being significantly negative. Since then, I guess there's a bit of raw materials have recovered, so these companies need to pass them through. Labor costs are still going up as well, and demand is weaker, but not in a recessionary territory. So they're having to pass these things through, and obviously to some extent this will probably continue to impact consumers.
All right, Daniela, thank you so much. We really appreciate you joining us this morning. That was Daniela Costa, head of the European Capital Goods team for Goldman Sachs Global Investment Research. Well, coming up, we're going to continue to take a look at how the markets are responding to that critical inflation data this morning, from PPI to consumer sentiment. So stay tuned for more. You're watching Catalysts.
We are about 90 minutes into the last trading day of a busy week on Wall Street. Let's do a quick check of the markets. You've got the NASDAQ regaining some of that lost momentum yesterday, up just about 1%, as we do see this rotation maybe back into some of those larger cap tech names. You're also looking at the S&P up just around 0.8%. And Maddie, you were pointing out earlier in the show the Russell 2000, this resurgence that we're seeing in terms of the small caps. As I hit the wrong buttons, let's go back to the Russell 2000 and pull up that larger chart there. The 5-day chart, you can see those gains really starting to extend here in the latter half of the week.
Yeah, it's interesting the degree to which we saw upside movement in the Russell yesterday compared with what we saw in the broader indices, the NASDAQ, the S&P, really indicative of this rotation narrative that we've been hearing about from a lot of our sources here on the show. You can see that dip right here in the NASDAQ yesterday off of some of the inflation data, which caused a little bit of a rotation throughout the day, perhaps some people covering their short positions on the heels of that inflation data. But then today, seeing this huge upward pressure in a lot of the large cap names, which is a reversal from yesterday. Given what we saw, I think it's consumer sentiment related, this idea that the Fed has even more of a reason potentially to be cutting sooner rather than later.
Yeah, and taking a look at inside the NASDAQ on an intraday basis, you are looking at names like NVIDIA, clearly thought of as and has been leading the market higher very much over the last several months. That's up just around 2.6% today. You've also got Apple up nearly 2%. In terms of the rest of the Mag 7 names, it's still a bit of a mixed picture with Amazon and Meta still under pressure, also Microsoft moving just below the flat line here today.
Yeah, it's interesting. We had an all-time high. We came off of that all-time high yesterday. Maybe we're heading back to another all-time high close today. We will see. But coming up, we've got Wealth. It's dedicated to all of your personal finance needs, and our very own Brad Smith has you right here for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we're talking about how Americans are feeling about the economy. Consumer sentiment falling just slightly in July from the prior month here. We'll get into why with an economist. And 5 signs inflation soon may be finished. We'll get to those points from Yahoo Finance's own Rick Newman and tell you how that is going to benefit you. Plus, mortgage rates ticking lower, and we're seeing a number of listings with price cuts. We'll tell you what it means for your home buying season, mission, and maybe even your weekend. It's a busy Friday morning here as we've got results from all the big banks, well, many of them kicking off the start to the second quarter earnings season. And we had some fresh data, consumer sentiment ticking just slightly lower in July. And the producer price index, PPI, coming in a bit hotter than expected, showing there are still some sticky areas of inflation. Here to weigh in on what these data points signal for the economy is Bill Adams, Comerica Bank chief economist. Bill, great to have you here with us. So, a lot of data points to really wade through on a Friday, a summer Friday at that, but yet many of them telling about where the trend of the economy is moving as well here. What do you give the most weight to here this morning?
Hi, Brad. I think the message from this morning's data is that the economy has downshifted in the first half of this year. And that's, I think, why consumers are feeling a little more downbeat in early July. Even though inflation is slowing, and the consumer survey showed that consumers are also seeing lower inflation and expecting lower inflation, consumers don't see as much, as rapid growth. They're not as upbeat about overall economic prospect. And the Fed's high interest rate policy has definitely slowed the economy in the first half of this year, and that affecting the outlook.
How much slowing do you think the Fed needs to still see for that rate cut, the first one, to finally come through?
I think the Fed just sort of needs to see the economy holding where it is right now. The real GDP in the first half of this year, I estimate, is a little under 2% annualized. And I'm expecting this pace to hold in the second half as well. And with that, there's a little margin of slack that's open in the labor market. Unemployment rate's back above 4%. Inflation is moving lower, kind of 2 steps forward, 1 step back. And that's the mix of data and economic conditions that the Fed wants to feel comfortable cutting interest rates. They're not going to cut them down to 0 overnight, but I think the outlook is for gradual reductions over the next 12 to 18 months.
And of course, as we kind of compare and contrast CPI and then the latest data out of PPI, it's still very telling about where there is more spending on the services side versus goods, and particularly on the production side here in the data that we got here today. Wondering your read through there.
It's a little bit mixed messages from yesterday's CPI to today's PPI, where we saw actually one of the big price increases in today's PPI report was retailing margins on autos were up in June versus May, where actual prices of new and used cars were down month over month in yesterday's CPI report. So to my mind, that suggests that we could be seeing some of those car dealers holding on to some of the margin as prices come down at auction, and that helping the car dealers in the middle of 2024. Although this was also a really weird month for car dealers. There was the CDK hack that held back auto sales last month. So I think the big takeaway from the inflation data is that core inflation, both by the CPI and the PPI, is a little over 3% year over year terms, which is not 10%, it's not 5%, but it's also not 2%. And so inflation's back close to normal, but not quite down to where the Fed wants it to be. And that to me says July is too early for a rate cut, but I think September is very much on the table, and I think there's good chances that the Fed will reduce rates at their following meeting in September.
Looking at some of the context that it came in with today's consumer sentiment reading. You know, there's one note within here saying that nearly half of consumers still object to the high impact or the impact of high prices, even as they expect inflation to continue moderating in the years ahead. And they also went on to mention with the upcoming election, consumers perceive substantial uncertainty in the trajectory of the economy, though little evidence that the first presidential debate altered their economic views. How much does the election have an overhang on consumer sentiment and consumer spending patterns?
It's typical in election years that you see uncertainty rise. You see that in consumer surveys and business surveys. A lot of business surveys now are showing that heightened uncertainty is increasing expectations that businesses kind of kick the can down towards the end of the year about big decisions, waiting to see what the election bears. And typically after the election passes, businesses sort of adjust to the new reality and things return to trend. So that may be a bit of an effect on consumer spending, business spending over the next 6 months. Really hard to judge the magnitude of it. But in general, what we see over the last year, 2 years, 3 years is a big disconnect between what people are saying versus what they're doing. Consumers are saying they're really downbeat on the economy on the one hand. On the other hand, spending on travel and tourism and recreation is still going really strong. So I think the economy is holding up pretty well this year, despite the headwinds of high interest rates. I think the risk of a recession in the next 6 to 12 months is pretty low. And net, this is a pretty good economic backdrop.
Yeah, net, you say you're upset about this, but I've seen your Instagram stories and it seems like you're still out there in these streets. Bill Adams, Comerica Bank Chief Economist. Great to have you here with us this morning.
Thanks for having me.
Certainly. Well, while producer price inflation came in a little stronger than expected today, consumer prices are on the downtrend. And according to our very own Rick Newman, we could soon be done with the whole inflation thing. There you see Rick. Rick, what are the signs that you're seeing that could prove inflation could soon be behind us?
First of all, goods inflation. Goods inflation is basically zero at this point. And some things are actually declining in price. Now, every time I say, oh, inflation is looking good, I hear from people who say, yes, but all the price increases the last 2 or 3 years, they're still there. The pace of increase may not be what it used to be, but those price increases are still there. That is mostly true. But some things are starting to get a little bit cheaper. Some prices are actually going down. And that's good. That's good news. I think we're going to see it later in things like food, which is obviously important to people because labor costs are an important part of that. But that's coming down. We are seeing cars are finally getting a little bit cheaper, especially used cars. So the sticker price shock in the used car market is basically over. And honestly, I think if you can defer a purchase, I think prices might continue to go down for both new and used. Car insurance has been one weird big driver of overall insurance. It's up almost 20% on a year-over-year basis, but that looks like it is flatlining, so maybe most of those increases have already happened. And the last thing is consumers actually are starting to feel better about inflation. When you look at surveys asking consumers what do they think inflation is going to be in a year, now they think inflation will basically be under 3% a year from now. And that's important for consumer psychology.
Right.
That affects how consumers spend today. It affects the type of planning, financial planning they do. We're not there yet. Rent inflation is still too high. There are a couple of sort of outliers where things are a little bit higher than they really ought to be. But I mean, the trend is good, and we are going to get to a normal inflation environment.
Yeah, on your point about the moderation in the years ahead for inflation, the survey of directors for University of Michigan director Joanne Shu saying exactly that more than half of the respondents, nearly half of consumers, still expect inflation to continue moderating in the years ahead here. Rick, stick around with us because we have a little bit more of a conversation that might be up your alley as well here. At least 3 more Democrats are calling for President Biden to end his re-election bid after Thursday night's post-NATO press conference, bringing the tally to 17. Despite current election uncertainty, it seems that markets are largely shrugging it off so far. To discuss, let's bring in Yahoo Finance's very own Julie Hyman here in studio with us. Hey, Julie.
Hi, Brad. And specifically here, we should say the equity markets have been shrugging it off thus far. One of the ways that we measure the nervousness in the equity market is the so-called VIX, the fear index, as some dub it, which basically measures volatility within the S&P 500. And Bespoke Investment Group brought us this chart, which I think is an interesting one. They picked July 9th, sort of a midpoint here of the election year-ish, and looked at where the VIX was going all the way back to election years to 1992. And it's the lowest this year at 12.5 on July 9th. So showing there's just not a lot of volatility, not a lot of movement around the election, at least not yet. Take a look at the VIX itself, and you can also see this. Here's the VIX year to date. Now, the VIX is affected by a lot, just like markets are affected by a lot. That has nothing to do with the election. And of course, the melt up in the S&P 500 is also one of the reasons why the VIX has been pretty low, except for a little bit of a bout of volatility back in April. So what is going on here? Why might we be seeing this sort of lack of action? Well, no matter who wins, some investors might see the election as sort of a win-win. After all, we have had a rally under President Biden, but as we saw, stocks also did well under President Trump. There have been some business leaders that have said they are looking for potentially to some kind of a pullback in regulation, potentially under Trump. That could be one of the reasons, perhaps. Also, for all of this talk about whether President Biden will or should step aside as the Democratic candidate, in the end, maybe he won't. Maybe it doesn't have a difference in the race, so it's not something necessarily that market participants want to place a bet on yet. And that brings me to point number 3. The election's just still too far away, right? And there's still too much uncertainty around it. There are other things that investors are paying attention to. There's also histories on our side. We tend to see stocks go up in presidential election years, and in particular, they tend to go up in the latter part of the year, although the stocks have already done very well this year. So we'll see how that enters into the mix. Now, to put all this together, we talked to Kevin Mahon yesterday, Hennian and Walsh Chief Investment Officer, and here's what he had to say about where the equity market's attention is right now.
I believe the market is more focused right now on when that first interest rate cut is going to take hold. And don't let it sway all of your decisions. Don't sit on the sidelines waiting for the outcome of the political elections.
And he said there are potentially some sectors where we could see more of an effect, more of a binary outcome, depending on which way the election goes. But the market has a lot on its mind right now in terms of investors, and the Fed is still number one, it seems, Brad.
All right, Julie, I want to invite you on over to the desk here because still with us we have Yahoo Finance's Rick Newman.
Come on over, Julie.
Come on down.
I mean, when you think about it, and Julie gave the perfect setup here, what do you think it'll take for the markets, the equity markets, to actually react? Is it just timing and proximity to the actual November date?
Yeah, get us to October 1st. I think you're going to see a lot more knee-jerkiness in markets based on which candidate seems to be a little bit ahead, who's behind, if anything changes. One thing I would add to what Julie pointed out, some Wall Street analysts feel like they have detected a little bit of movement in interest rates based on analysis of who seems more likely to win. So I wrote about this a couple of weeks ago. When there was a point when it seemed more Donald Trump's election odds improved, and rates went up by more than you would have expected based on everything else going on in the markets. And there were a few Wall Street economists who said, we think what's going on is markets are looking at two Trump policies that would be a little more inflationary than the status quo, which would be the tariffs on imports, which just raises prices. That's inflationary on its face. And then Trump saying he's going to go around and have this mass deportation of undocumented migrants, which would just take a chunk of labor out of the United States. And those are two things Trump could do without Congress having to act. So they think, well, that suggests inflation might be a little bit higher under Trump, and maybe the Fed will not be able to cut interest rates. But then I think markets have settled down, and we're just in a steady state. And what markets are looking for is not a 1 or 2 percentage point change in the polls, but does the outlook for the outcome change? Does it go from Trump seems more likely to then Biden seems more likely? And it's just too early.
Right.
Yeah, I mean, and the polls are still too close also this far out from the election. The other thing I would say is there was, the Wall Street Journal did a poll today on this exact topic you're talking about, which is the outlook for inflation under each of the existing candidates. And indeed, there is this broad agreement that under Trump it would be higher.
Right.
I was talking all about the VIX, which measures volatility in the S&P 500, but there is also a bond market volatility index called the MOVE index, MOVE. And that one has been seeing a little bit more activity in line with what you're saying about interest rates. So that would be the other thing to watch as well as sort of a proxy or maybe something that's following a little bit more closely what the election odds are.
One thing I would add is markets care not just which individual wins the presidency.
Yes.
There's actually more than two outcomes here because there are actually four. So does Biden win with a fully Democratic Congress or with a split Congress? And then does Trump win with a fully Republican Congress or a split Congress? I think markets care less. Markets want divided government because that means fewer radical changes. If you get a sweep by one side or the other, that suggests deeper changes on things like tax policy and stuff like that. So as we get closer, again, it's too soon to expect markets to be pricing any of this in. But markets will be watching not just who seems likely to win the White House, but what the full outcome for government, whether divided or united, partisan, seems to be in October for sure.
Which actually made that NATO summit even more important, especially as both candidates have their own stance on international business and foreign relations and where tariffs would be perhaps ratcheted up because of what's been campaigned on to this extent and this early on versus where there's more of an alliance that the other is looking to perhaps solidify a little bit more at this juncture. Julie and Rick, thanks so much for taking the time
guys.
with me here today. Also, everyone, coming up, we're taking a look at the health of the consumer through big bank earnings lenses and credit card delinquency rates. Find out more next. Big bank earnings giving insight on the state of the consumer for JPMorgan, Wells Fargo, and Citi. Credit card delinquencies have dipped compared to the first quarter, but missed or late payments are actually up on an annual basis. To break down why delinquencies have been on the rise and what you can do to avoid it, we've got Martin Lynch, who's the Financial Counseling Association of America president. Martin, great to have you here, and thanks so much for taking some time here on the show. You see earnings reports like this come about and give us a little bit more update on where delinquencies stand. For those who find themselves as part of that bucket that banks are reporting on, what is the first step that they can take to eradicate some of their delinquency status?
Well, thanks for having me, Brad. The first thing that people should do when they're about to go delinquent or miss their first payment is to stop and do a budget, talk to a counselor if need be for assistance, and figure out are there temporary reductions at least that can be made. A lot of people treat budgeting like a four-letter word, and they avoid it like the plague because they don't want to make any kind of reductions in their lifestyle. But really, they should come at it from a different viewpoint. Look at it as a tool to preserve your lifestyle, and it's a lot easier to do.
What are some of the common areas that you hear people looking at then their budget and saying, okay, I immediately need to think about cutting this or reducing this spend, and especially when you think about some of those discretionary categories?
Well, when it comes to discretionary spending, it's usually where the reductions can be made, but those are the lifestyle standards that people get used to or get wedded to. So it's tough for a lot of folks. But if they adopt that flexible mindset, they can find that they can cut their cable service for the next 6 months or for the next year, reduce, make similar reductions like that. Instead of dining out regularly, cut it down to 1 or 2 times a month. Those kind of temporary, softer reductions are easy to accommodate, and they're actually empowering too, because they're going to give you that sense of control over your budget when you start making payments on time again. That's a good feeling, and it's addictive in a way. You know, you really assume control over every dollar that's coming out of your wallet.
Say that you have gone into a delinquent status or have become delinquent on payments. So now you have to think about, all right, what are the first steps I can take on that pathway to getting back into good standing?
Well, unfortunately, a lot of folks make a couple of critical mistakes at that point. They'll turn to a debt settlement company. They dominate late night media advertising. Folks are lured by the promise that they can repay half of what they owe. There's a dirty secret the banks don't want you to know. None of that is true. Banks want you to repay your principal in full plus interest. So we encourage folks to look at communicating with their lenders. If you come through a nonprofit counseling agency, folks will be surprised that in addition to our free counseling, we'll work with your lenders to reduce your interest rates from 25 or 26% down to 6 or 7 or 8%. And that gives the breathing room in the budget that allows people to make timely payments, maintain a good communication standard with their lenders, and emerge in a much healthier way. They won't destroy their credit. They'll come out okay.
Is there any negotiating that people can do, individuals can do that have fallen delinquent in order to make sure that it doesn't further impact them?
Well, it's interesting. You can talk to your creditors one-on-one to ask for rate reductions, but it's harder to pull off. They like to see that you're working with a professional like an FCA member agency, because they know, number one, we're going to look at the full picture. We're going to go through your credit report and make sure that you're not omitting any debts, and that we're going to treat you holistically and deal with all your accounts, not just that one account with their bank. Nobody likes to be singled out, so banks prefer that you work with a professional, and then they're more apt to grant rate concessions like I described.
Interesting. Martin Lynch, who's the Financial Counseling Association of America president. Martin, thanks so much for taking the time, and have a great weekend.
My pleasure, Brad. You too.
Traders anxiously awaiting on SEC approval for the first spot Ether ETFs, which could come in weeks or even days. For more, let's bring in our own Jared Blickery, who's been keeping close tabs on the movements here. Hey, Jared.
That's right, Brad. Crypto itself has been under pressure recently, with both Bitcoin and Ether down more than 20% from recent highs. But there's excitement in crypto land over a new batch of ETFs that could launch as soon as next week. Similar to the spot Bitcoin ETFs that listed in January, spot Ether ETFs from BlackRock, Fidelity, Bitwise, you know the names, they've been busy updating their S1s at the SEC to bring more liquidity to the crypto market. And if you're scratching your head wondering, I thought we already had Ether ETFs, well, you're correct. The securities watchdog already approved several ETFs in October last year that are based on futures, and that's a critical difference because it can be more difficult for these futures-based ETFs to track the underlying crypto prices. And that's why in January this year, there was so much excitement over the spot Bitcoin ETFs, which the SEC had resisted for so long. In fact, the timeline on bringing crypto products to the masses through ETFs has a long and storied history that begins far before the pandemic. Remember the Winklevoss twins? They tried to get a spot Bitcoin ETF approved way back in 2013, only to have it finally rejected in 2017. But the first crypto ETFs would not launch until October of 2021. And those are the type that are based on futures. The issue at the SEC was Gary Gensler himself, who mowed down spot crypto applications until the SEC lost a key court battle with Grayscale Investments. That battle was over the right to convert Grayscale's GBTC exchange-traded note, which could only be sold under limitations, into an exchange-traded fund that could be bought by any member of the public. After the FTX bankruptcy nearly closed the lid on the entire crypto industry in 2022, the Grayscale court victory lifted spirits as a promise of a spot Bitcoin ETF finally came into sight. And when they finally listed in January of this year, investors bought them with size. The iShares Bitcoin Trust IBIT has raked in $18.1 billion, and that's almost twice the flows that Fidelity's offering bought. In fact, IBIT is the fourth biggest ETF flows winner of the year in the US, of all ETFs. It's also notable that the Grayscale Bitcoin Trust, GBTC, has seen outflows of $18.7 billion, which is nearly the reverse of what BlackRock's IBIT was taking in. And the reason in part has to do with the 1.5% management fee that Grayscale still takes, which has to compete with zero fees from some other offerings. It's also worth mentioning because we could see a similar dynamic play out here, where we might see rotation out of Grayscale's ETHE fund in favor of the lower cost options. And that could all start as soon as next week. All of these spot Ether ETF managers, they're dotting their I's, they're crossing their T's, and anecdotally, the comments they've been getting from the SEC, they are next to nothing. So it seems that we are close. And the effect that all of this may have on the price of Bitcoin and Ether, is it going to affect prices at all? Well, it's worth remembering that Bitcoin saw a huge price bump from excitement over the spot ETFs, but when launch day came, there was a price drop. Quickly, prices rallied to fresh all-time highs, and that's in part because there was so much attention on these Ether ETFs. So we'll have to see what the future brings here, but it looks like next week we're going to get some more crypto options to put crypto in people's portfolios and 401ks, Brad.
Jared, tracking all of the asset types surrounding the crypto landscape. Jared, appreciate it. Coming up, everyone, mortgage rates ticked lower once again this week. I'll talk to a mortgage expert about how this is impacting home buyers next on Well. Mortgage rates have seesawed the last few weeks, most recently ticking lower to 6.89%, according to data from Freddie Mac. So how are these swings impacting home buyers? Joining me now, we've got Melissa Cohn, who is the William Ravis Mortgage Regional Vice President. Great to have you here with us. Okay, so what are the kind of immediate impacts that we're seeing, at least in some buyer activity, between what we were seeing in a long-term or long-standing 7% and us finally cracking below that and kind of maintaining below that rate for a few weeks now?
Well, I think we're definitely seeing more enthusiasm from buyers as interest rates are starting to tick down. And based on what some Fed members have said over the course of the past day, that the thought that a Fed rate cut would actually probably happen in September has gotten people to be excited about coming back into the real estate market and thinking now is a good time to buy.
And so with that in mind, where are we seeing it impact both existing listings out there for starters and potential home buyers that are willing to bid into even some existing bidding wars that might be taking place?
Well, I think with the knowledge that it looks like interest rates are really, on the decline and will continue to decline through the balance of the year over the course of the next couple of years, that more people are now saying, you know what, maybe I should get back into the real estate market and look at the opportunity to buy now before rates do really come down and real estate prices go back up again. And when interest rates are high, there are fewer buyers in the marketplace because of the affordability issue. So now is probably a great time to get into the market and purchase, knowing that as rates do come down, you still have the opportunity to refinance, but the cost of entry is definitely declining.
What do you say to those? And I had these conversations with some friends over the past weekend and couple weeks, as of course, there are a lot of social functions brewing once you get into the July 4th week and everything. But everybody's trying to figure out, okay, should I be waiting for that interest rate cut that we're now anticipating, at least the probability showing that we could see one in September?
Well, I think it's a question of doing the math. If you were to buy today and the value of the home that you're buying is, call it $50,000, $100,000 less than it will be in a year, and you're going to pay a few $100s more a month on a mortgage for that year, it pays to buy now and then consider refinancing.
We had seen some recent data from Redfin, I believe it was either last month or within the past several weeks here, talking about how the election might impact the housing market and a lot of potential home buyers trying to figure out, what the home market's telling them going into the election and how that might impact their vote. What's the correlation there that you're tracking?
Well, I think the correlation is really probably more interest rate related. We've seen that there's been some volatility in the bond market surrounding the election, post the last debate. We saw bond yields rise by 20 basis points in a 2-day period. We've now gained that back with the economic data showing that the economy is cooling. But, the election is a little bit of an unknown in what's going to happen. But, life will go on and people will continue to need a place to live.
And so for people out there who are looking for perhaps a new place to live, and they've got their list, they've checked it twice, they're trying to figure out how much time they're spending at open houses this weekend, what tips do you have for home buyers?
I think look for opportunities, obviously. If you have a property that's been on the market for a longer period of time, you'll probably have more negotiability. If you're looking at a property where the mortgage that you're going to take is a conforming loan under the $766,000, and it's a property that's been on the market for a while, consider asking the seller or the broker to offer you a temporary buy down where you can take advantage of a lower rate now. A temporary buy down would be where a rate can be 1 or 2% lower for the first year or two. So if the average rate, call it 6 7/8% today with a 2-1 buy down that a seller can pay for, you could be borrowing at 4 7/8% for the first year. So you feel like you've already won the war.
Wow. Great advice there. Melissa Cohn, William Ravis Mortgage Regional Vice President. Great to have you here back with us on Wealth. Appreciate it. Definitely. Coming up, everyone, almost half of Gen Z relies on family for financial assistance. We'll break down why when we return. Gen Zers are struggling financially. According to a new survey from Bank of America, don't come for me, Gen Zers, please. Almost half of all Gen Z relies on some form of financial assistance from their family. To help us take a deeper dive into the survey, we've got Shauna Stevens, who is the Bank of America Community Banking Senior Vice President here. Shauna, great to have you here on the show with us. Okay, so let's dive into some of this data because, I mean, Gen Z is also like, if you split it up, sure, there's the upper half of Gen Z that is entering into the workforce, and then the kind of lower half of Gen Z, still young enough to be, I think, in middle school or, early high school. So, I mean, there is still that reliance on their parents, but what are we seeing in terms of the fundamentals of how those kind of financial constructs are starting to take shape for this generation?
Great question. Thank you so much for having me. With the Gen Z in our study, we started at 18. We went from 18 to 27 with our study in terms of what we were looking at with our Gen Z. And what we were seeing is exactly what you just said. They're really feeling the strains of the high cost of living. And it's really taking the toll because of their young age and because they're so early in their careers.
Certainly. And when you think about how this generation compares to previous generations at this juncture, what did you find?
At this juncture, what we're seeing is it's somewhat comparable, but they are facing some headwinds that some other generations did not have to face, given some of these high costs of living. But we are seeing some things with Gen Z that are giving us we're really optimistic. And we're seeing behaviors with Gen Zs that we haven't seen in other generations.
Interesting. Okay, so let's break down some of those behaviors because this is a generation that's had more access to technology, more access to being connected with people, with data, with information and entertainment as well, more than generations prior. So how is that being utilized to also form their own understanding or good money habits?
They're really taking their finances under their own wings and taking control of it. What we're seeing with Gen Z is the majority, about 82% of our Gen Z actually have financial goals. So they actually have a financial roadmap that they're following. The other thing that we're seeing with Gen Z, with everything that they have at their fingertips, is they're making the right adjustments so that they can cope with these high costs of living. And the steps that they're taking is they're looking at dining out and they're passing on those. They have events with friends, and if they can't afford them, they're also passing on those. And when they're choosing their grocery shopping, they're even looking at more affordable grocery shops to do their grocery shopping. We talk about the fact that they have access to social media, and some of the social media trends have been negative in the past. But what we're seeing, and again, that gives us so much optimism, is loud budgeting. So with our Gen Z, not only are they declining social activities and social opportunities that they can't afford, but they told us about 38% said they feel very comfortable not only declining, but admitting that they just can't afford that expense.
Yeah, it's very transparent on their part, shameless transparency and healthy as well. So with that in mind, what does that set up for the trajectory once they get into some of those peak earnings years?
It's right now what we're seeing, though, is the Gen Z are saying that they aren't able to save. So if you think about planning for those peak years, there are traditional milestones that you tend to hit, such as buying a home, saving for retirement. And what the Gen Zs told us in their study, about 50% aren't on track to buy a home in the next 5 years. They also said about 46% that they're not actively saving for retirement. And then another 40% really shared that they don't anticipate that they'd start to invest in the next 5 years. So with those traditional milestones being delayed, that does cause a bit of concern. But the key thing that Gen Z needs to understand is this importance of budgeting and to start saving frequently and often.
Shauna Stevens, who is the Bank of America Community Banking Senior Vice President. Great to have you here on the show with us. And thanks for breaking down some of these findings.
Thank you for having me.
Certainly. Well, while Gen Z may be struggling to start saving money, they are not the only ones worried about their wealth. A new survey from BlackRock shows that while confidence about retirement savings among Americans is up, women are more likely than their male counterparts to be worried about staying on track financially. And for more, let's bring in our own Carrie Hannon, who's been digging into this report. Carrie, what have you found?
Hey, Brad. It's absolutely true. What this BlackRock report found is something that I've been seeing for decades, to be honest with you. Women simply are not confident about their retirement savings. They feel like they're going to outlive their money. They're not on track. And so really, when we talk about a retirement crisis in this country, it's often a women's crisis because of several factors that sort of set women up for this gender. So it's not Gen X versus Gen Z, but it's a gender issue when it comes to retirement confidence. And here's it. I mean, Brad, women tend to live longer, roughly 6 years longer than men. So they have to fund a longer retirement. They tend to be out of the workplace for caregiving at different junctures during their career. They tend to have, this is no surprise, we talk about this a lot, there's a pay gap, right? They have lower earnings than their male counterparts in general moving forward. And also they have higher health care costs. Even pre-retirement, women pay more for their medical insurance, their medical health care costs than men do. After retirement, same is true in Medicare expenses and so forth after retirement. So I think these are issues that women face, and so it results in a savings gap of something like 30 to 40%, according to the folks at BlackRock who I spoke to. And it is concerning. So I think there's one other caveat here when you look at this sort of reporting that shows that there's this great lack of confidence. Maybe it's that men perhaps are a little overconfident and women are a little more realistic.
So, Carrie, what tips can the audience at home start to deploy for themselves to be more confident?
Yeah, Brad, I think at all ages and both women and men, the first thing that you really should do is try to save enough. If you have an employer-provided retirement plan, try to save enough to meet that employer match, which is usually about 4 to 6% of your salary. So if you can bump up your total, the combo of yours and theirs, to a 15% a year savings rate, that would be amazing. It would be really get you rolling forward. And if you can tick it up higher, absolutely do so. Run the retirement calculators. I know that it's not perfect. It's not going to give you, absolutes, but it gets you thinking about what's out there. So most of the major mutual fund and financial services companies have there, but Vanguard has a good one. AARP also does. So try to run your numbers. Just take the time and start thinking about it. And again, don't get stuck that it's just what you're saving in your retirement plan at work or in that thing. Look at your entire wealth picture. That might make you feel just a little bit better because you may have home equity, you may have savings outside of your retirement accounts, and of course you hopefully, if all goes well, you're still going to have your Social Security. So it's not all lost, but there are other ways to build your confidence by looking at the whole picture.
Carrie Hannon, thanks so much for tracking the results of this survey, breaking them down for us here today with some actionable tips. Appreciate it.
Thanks, Brad.
Coming up, everyone, spend and save all the tips and tricks that you need to get the best deals surrounding Amazon Prime Day right after this break.
From its start as an online bookstore to its rise in e-commerce and cloud computing, Amazon has become one of the world's most iconic brands. In 2023, the tech juggernaut generated over $575 billion in revenue and boasted more than 200 million Amazon Prime members worldwide. Beyond the Ticker takes a deep dive into some of the company's biggest moments. Amazon was founded in 1994 by Jeff Bezos in his garage in Bellevue, Washington. The company was originally conceived as an online bookstore designed to compete with Barnes & Noble. On May 15, 1997, Amazon went public via IPO at $18 per share. 1 year later, the company began selling CDs, marking the start of its effort to become a shopping Goliath. In 2005, Amazon launched Amazon Prime, a $79 per year membership with free 2-day shipping on eligible orders. A year later, Amazon launched Amazon Web Services. The platform would go on to become the top cloud computing service ahead of those from rivals Microsoft and Google, and one of Amazon's most successful businesses. In 2011, Amazon rebranded its video service as Amazon Instant Video, with access to 5,000 movies and TV shows for Prime members. 3 years later, Amazon acquired the video game streaming website Twitch for $970 million. Amazon then acquired high-end supermarket chain Whole Foods in 2017 for $13.7 billion. It has since integrated the two companies, offering discounts for Prime members. On September 4, 2018, Amazon became just the second U.S. company ever to reach a $1 trillion market cap after Apple reached it earlier in the year. Amazon sales and profits surged during the COVID-19 pandemic in 2020 as consumers turned to online shopping. In 2021, Bezos announced that he would step down from his role as CEO and be succeeded by AWS CEO Andy Jassy. In 2024, Amazon was added to the Dow Jones Industrial Average, replacing drugstore giant Walgreens. The company continues to evolve, investing billions in AI startup Anthropic, developing more smart home products, and launching an AI shopping assistant named Rufus. It's safe to say Amazon is a staple of the digital age.
Attention, all coupon cutters, discount divers, and savings savants. Amazon Prime Day 2024 is just days away, starting on Tuesday, July 16th, running through Wednesday, July 17th. Amazon members, they get access to millions of deals on the annual event. Here to cut through the noise and tell you about some of the best ways to save. We've got Nick Wolney, who is the managing editor over at CNET. Nick, great to see you. Thanks for hopping on here with us. All right, let's break down some of these deals. What do people need to know, especially as we go into this almost like Christmas in July type of shopping bonanza, if you will?
Christmas in July is definitely a good way to put it, and Amazon knows what they're doing at this point. It's the 10th year that they've offered Prime Day, and we actually have seen a total evolution of summer shopping as a result of that. Walmart just did a deal as well. Target had a week-long deal. We're definitely seeing a theme of retailer subscriptions. Prime Day is best for Amazon-branded products. So if you're looking for something like an Echo speaker, an Alexa, maybe a Kindle, maybe a Ring doorbell, then this is going to be the absolute best time of year in terms of prices for those products. It's also a really good event when it comes to smart home product shopping and electronics in general. So often this time of year ends up getting conflated with back to school shopping season. People get kind of an early start, particularly if you have kids going off to college, needing electronics, things like that. You'll see really aggressive discounts. You're also going to see more aggressive discounts from retailers in general as they're trying to undercut one another. E-commerce competition is definitely heating up, and consumers are also definitely feeling the heat. Even though CPI was down slightly last month, what we also know is that consumers don't care a lot about CPI. They care about what the price is on their receipt when they get their groceries at the supermarket. And so they're being a little bit more choosy with prices and discounts this year than in years past.
Absolutely. When you talked about the number of different retailers that are running their promotional specials, what can consumers do in the form of what they would normally do, which is go into a store and say, hey, your competitor has it at this price? Is price matching an option when you hear about some of the jousting that these retailers are doing, especially during blitzes like this?
Yeah, you'll definitely see some price matching language and opportunities, particularly between the biggest retailers. Walmart, Target, Best Buy can potentially be offering price matching as well. And it's good to take that time and really comparison shop along the way. There are some nice widgets and nice plugins that you can look into. Camel, all one word, is one of them that will allow you to comparison shop on a product. If you're looking at the price of a product on, say, Amazon, and it's actually available for a lower price on something like Walmart, Walmart.com or Target.com, you'll be able to get an alert. And that really is the digitized version of comparison shopping and coupon cutting. It's going to help you ensure that you get the lowest price. And for some retailers, different categories of products are cheaper at one retailer than they are at another. So that's going to be an easy, low lift way to keep up on where the lowest prices are.
How do you spot a good deal? I mean, what's the average type of discounting that we should be expecting as shoppers?
It'll widely vary depending on the type of product. You could see discounts anywhere from 10 to 50%. What we also are seeing is for products that are especially popular, Amazon, it's the second year that they're offering something called invite-only deals. And so it kind of works a little bit like a lottery. You indicate your interest in a particular deal, and if you get the golden ticket, then you're going to be eligible to get that item for that price for a limited amount of time. An example of that would be 40% off Sony headphones, 30% off some Peloton products. Those are really good deals, really aggressive deals, but there's limited inventory. And so Amazon wants to just up the ante and, create more urgency, create more scarcity. So this is the second year we've seen this invite-only option. You can only apply for one product at a time using that invite-only option. But if you really know you want a great deal on one particular item, one particular electronic gadget, then that might be a good thing to sign up for in the next few days as well.
Nick, I only got 30 seconds left. Got to hustle to the finish here, but when do I know when not to buy something, when not to press purchase or check out?
Well, comparison shopping is going to be the best way to go. Also, the CMET Commerce team has said that Amazon's actually not the best retailer for back to school. So often this time of year gets conflated with back to school shopping. Walmart and Target are going to have better prices for those back to school supplies. So maybe check them out in order to get those best deals.
Nick Wolney, who's the managing editor over at CNET. Nick, thanks so much for taking the time here with us today. Appreciate it.
Thanks for having me.
Certainly. Hey, everyone, let's do a quick final check of the markets here as we've got the Dow, the S&P 500, and the NASDAQ all in positive territory right now. You're seeing fractional gains pretty much across the board except for the NASDAQ. That's up a little more than 1%. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. You don't want to miss it.